A very good morning. आप सभी का बहुत बहुत स्वागत है और आप सभी से गुजारिश करेंगे कि आप सब अपनी अपनी सीट्स पर बैठ जाएं ताकि हम इवेंट शुरू कर सकें. May we request all the guests to settle down, please? Requesting everyone to please take their seats and please ensure that your cell phones are on silent mode so there are no disturbances during the event. So good morning and welcome to the second day of the Gatekeepers of Governance. Welcome to our plenary session. Regulatory gaps and overlaps, do they exist? Gaps and overlaps have been witnessed in the regulatory space. Is more interregulatory coordination the need of the hour? May I first request Mr. Damodaran to welcome all our guests on stage. May we welcome them on stage with a round of applause, ladies and gentlemen. So our speakers for the day are Mr. Ajay Seth. He is the Chairman of Insurance Regulatory and Development Authority of India, IRDAI, since September 2025. He was appointed as Secretary Department of Economic Affairs in 2021 and was made Finance Secretary in March 2024. Over the years, he has worked in several domains of public finance, social sector, administration, urban transport, and infrastructure, dealing with matters concerning public expenditure, tax policy, and administration. Budgets, accounts, project appraisal, foreign investments, bilateral and multilateral financial cooperation, development financing, public-private partnerships, school education, health, urban transport, and infrastructure. Ladies and gentlemen, Mr. Seth. Our next speaker is Mr. J. Swaminathan. He is the Deputy Governor of Reserve Bank of India, RBI, since June 2023. As Deputy Governor, he looks after Consumer Education and Protection Department, Department of Supervision, Financial Inclusion, and Development Department, Inspection Department, Premise Department, and Raj Bhasha Department. And prior to that, he was the Managing Director, Corporate Banking and Subsidiaries of State Bank of India, SBI. In a career spanning over 34 years with SBI, he has held various assignments across corporate and international banking, retail and digital banking, finance and assurance functions, and he has also served as chair of the Advisory Group to Regulations Review Authority, RRA 2.0 of the RBI during 2021 and 2022. Ladies and gentlemen, Mr. Swaminathan. Our next speaker is Mr. Raman. He is the chairperson of the Pension Fund Regulatory and Development Authority, PFRDA, since June 2025. And prior to this, he was the Deputy Comptroller and Auditor General of India. He is an officer of the Indian Audit and Accounts Service. He was the Chairman and Managing Director of Small Industries Development Bank of India, SIDBI, from April 2021 to April 2024. And before joining SIDBI, he was Managing Director and CEO of the National E-Governance Services, NESL. Prior to joining NESL, he was the Principal Accountant General, Audit in Jharkhand. Earlier, he worked with SEBI for 6 years, initially as Chief General Manager and later as Executive Director between 2011 and 2013. He also worked as First Secretary at the Indian High Commission, London, for auditing the accounts of various Indian embassies in Europe. Ladies and gentlemen, Mr. Raman. Our next speaker is Mr. Kamlesh C. Varshne. He is the whole-time member, Securities and Exchange Board of India, SEBI, since September 2023. He handles various departments like Market Intermediaries Regulation and Supervision Department, Legal Affairs Department, LAD 1, Integrated Surveillance Department, Information Technology Department, Recovery and Refund Department, and Special Enforcement Cell. And prior to this assignment, he was the Joint Secretary, Tax Policy and Legislation in the Department of Revenue, Government of India. Ladies and gentlemen, Mr. Varshne. And moving forward, may I now request Mr. Damodaran to share a few words.
Good morning, ladies and gentlemen. It's good to see all of you back. Hope you had a restful night after day-long sessions yesterday. I know that it can be very tiring at this stage in life for most of you, and I speak for myself also, to sit on straight-back chairs and listen to serious speeches on serious subjects. It can be quite taxing, it can be quite tiring, so I hope you've managed to catch some rest between yesterday evening and this morning. And thank you for turning up in large numbers. The second day is often a challenge for people who organize programs like this, to see that we get enough people in the audience. But what we are serving today is fare of the kind that you will rarely see, because alongside me here, I have 4 persons holding very senior positions, leadership positions, pole positions in regulatory organizations. And I'm privileged today to formally welcome Mr. Ajay Seth, Chairman of the Insurance Regulatory and Development Authority, Mr. Swaminathan, Deputy Governor and an SBI veteran, if I may call a young man that. Mr. Raman, my old colleague, young old colleague. He's young, but we were colleagues quite some years ago in SEBI, and Kamlesh Varshne, who now handles some of the difficult, if I may say so, departments in SEBI and is trying to give it a human touch. 4 regulators on stage, and you might wonder what the 5th guy standing up here now is doing. Just trying to imagine the years gone by when I too used to be a regulator. And that is why I thought I will sit in this company. I have nothing more to share with you, so that I can also relive the experience of being a regulator in such august company. Just one announcement I made yesterday, I won't take up too much time, is that yesterday we formally launched, those of you who were not here yesterday, this is especially for you, we formally launched an initiative called the Directors Community. It's not for independents, it's not for non-executives, it's for all directors. The entire community of directors, and therefore we call it the Directors Community. The details you can get if you access the QR code which is in front of you. And I urge you to join this in large numbers, because I personally believe, and I've heard this from people in SEBI, that independent directors must articulate their thoughts in an organized manner, not everyone firing off from here and there, and be a kind of a body with which, even though it's not structured, with which we can engage as part of the consultative process. And therefore we started this initiative. It's a pan-India initiative. The interesting thing is there are no membership fees and all of that stuff. There are some benefits that you might gain, but some benefits that you too should bring to the table because of your experience. I thought I would mention for those of you who were not here yesterday but are here today, and pass that message around. Without further ado, let me turn it over to the speakers. You've come to hear them. I have a ringside seat. I will hear them from here. I will not impose myself on you with any long speech. That's not my objective of being here. The available time is theirs. As in the first session yesterday, there will be no questions and answers. Because as you know, regulators ask questions. We don't ask them questions, right? Okay. We do sometimes, but you can't do it in fora like this. Let's utilize the available time to hear them. Thank you very much. And without further ado, may I request Mr. Ajay Seth to come.
There we go. Namaskara. A very good morning to all of you. If I can speak for all people present here, and certainly for myself, we are here for the high regard we have for Mr. Damodaran, and the kind of a leadership and in professional field, in financial world, and in the regulatory space he has created for everybody. It is a master stroke on his part to get all 4 regulators on the dais and make them speak on regulatory overlaps and gaps. And he's on the dais so that all 4 behave themselves. So that's Mr. Damodaran. I'm truly delighted to participate in this summit. Over the years, this forum has evolved into more than just an annual conclave. It has become a crucible for ideas, a platform that brings together regulators, industry leaders, and governance practitioners, united by a common purpose to strengthen the moral and institutional compass of our financial system. In an era where markets evolve faster than the laws that govern them, and technology redraws the boundaries of engagement overnight, regulators today shoulder an ever-deepening responsibility. A responsibility that demands not only vigilance but imagination, for the foresight to anticipate risks, the agility to adapt frameworks, and the courage to uphold the public interest at all times. As regulators, we are often accused of doing both, too much and too little. Too much when the oversight feels heavy-handed, and too little when innovation on crisis expose an unguarded corner. As a developing country, we need to create ample space for innovation to thrive. We cannot afford to have a no-accident policy. We need to build resilience to deal with any accident or misadventure, but innovations must thrive. So the question of this session, do regulatory overlaps and gaps exist, may be complemented by another question, that is, do we have effective, efficient, and robust systems to deal with the overlaps and gaps? Let me take up the complementary question first. The interregulatory coordination aiming at dealing with those situations aims at 6 objectives, namely, manage the overlaps, second, find gaps, find bridges to fill the gaps, cross those gaps, ensure financial stability, promote financial sector development, fifth, lead efforts for financial literacy and financial inclusion, and the last one, undertake macroprudential supervision of the economy, including the functioning of large financial conglomerates. The current system is 4-tiered. At the apex level, there is a Financial Stability and Development Council chaired by Finance Minister. Thereafter, the next tier is a subcommittee of FSDC chaired by Governor RBI. Third tier is a specific inter-regulatory forums under the guidance of FSDC for early warning, monitoring financial conglomerates, fintech and financial inclusion, and the fourth tier is each of the financial sector regulators. In addition, there is a specific provision brought in about 15 years back, Section 45Y in the RBI Act, prescribing a joint mechanism to resolve a large set of potential overlaps. The experience show that these systems are working fairly well. Of course, more needs to be done in terms of developing the financial sector. I list a few. 1, development of secondary market for corporate bonds in general. Second, supporting framework for issuance of long-term corporate bonds, especially in infrastructure sector. And investors from the insurance industry face a particular challenge on this particular aspect. Third, development of unlisted equity market. Again, investors or the insurance company insurers find it difficult to get into that space. Fourth, a basic minimum common framework for large financial conglomerates in corporate governance, assurance function, and cyber security. And fifth one, developing market to support instruments to help release and recycle entrepreneurial capital. The regulatory gaps may lead to vulnerabilities as well as non-level playing field for regulated entities or even for the financial sector. On the other hand, the overlaps may lead to compliance overload or differing risk assessments resulting in suboptimal regulations. And we deal with both sets of issues. The experience of the past 10 years show that both sets were dealt in prudent manner. I list a few of them in the recent years. One, management of the financial sector during and after the COVID period, the way all regulators came together along with the government to deal with those situations, the volatility in that situation. Second, code of conduct for alternate investment funds brought out by SEBI and RBI's regulations for lending to entities having investment by AIFs in which regulated entities may have provided contributions. Third, participation of non-bank brokers on NDS-OM platform to facilitate retail transactions and government securities. Fourth, backstop facility for investment of mutual funds in corporate bonds during periods of market volatility. Fifth, valuation of AT1 bonds, not the regulators here. NFRA was the regulator which sorted out that issue and provided the way forward. Sixth, participation of domestic financial institutions in GIFT IFSC through branch mode. Of course, there are several areas where inter-regulatory coordination is a work in progress. Again, to list a few. First, cyber security and prevention of cyber frauds. Second, harmonization of KYC norms, extremely important from the consumer's perspective. Third, pension products, wherein Mr. Ramanan and I and all of us, including the SEBI, we are working together that how do we take that piece forward. Fourth, sharing of distribution channels across regulated entities under different regulators. Fifth, framework of function-based regulations. And sixth, transparency and benchmarking of cost of procuring business and intermediation. The first three, namely cybersecurity, KYC norms, and pension products, are getting attention with participation of all concerned regulators in the government with 3 separate high-level committees. Let me look at a slightly broader picture presented before you. At times, the different paths adopted by regulators lead to challenges in communication from public's perspective. Today, banks, mutual funds, pension funds, and life insurers all provide savings management services. For banks, net interest margin is the metric of cost of intermediation. For mutual funds and pension funds, the cost is benchmarked to assets under management. For insurers, the cost is benchmarked to the premium. These differing matrices make it difficult for the public to make informed decisions about their savings and managing those savings. A related example is bank assurance. The largest private life insurer pays 4% of all premium generated through its parent bank as commission. The second and third largest insurer in the private sector pay more than 15% to their parent bank and other corporate agents, almost 4 times. The industry average is around 12%. All this information is not even known to policyholders. Prima facie, their interest has become subordinate to interest of regulated entities. As financial sector becomes digitalized and interconnected, regulations of one segment by a sector regulator may give rise to regulatory gaps and overlaps requiring a close inter-regulatory coordination. The prime example of emerging challenges of interlinked financial sector could be found in the efforts of public authorities in formulating coordinated strategies on strengthening cybersecurity in the financial sector and climate risk resilience. As regards increasing interlinking of different segments of financial sector, there have been many instances in the recent past, domestically and globally, where the functioning or disruption in one segment of the financial sector has resulted in financial stress and instability in other segments or even overall financial stability. Here, within the country, the ILFS default crisis in 2018 led to severe disruption in functioning of the corporate bond markets, requiring several liquidity support measures by the government, RBI, SEBI, in a coordinated strategy to strengthen the financial stability. The Financial Stability Assessment report of 2025 by IMF and World Bank has acknowledged that Indian authorities have advanced cybersecurity risk oversight, especially for banks, but has recommended that extensive cybersecurity crisis simulations and stress tests for banks could be expanded for cross-sectoral and market-wide events. It is encouraging to note that in the context of FSDC's work in the 29th meeting in June 2025, the Council had has considered strengthening the cyber resilience framework of the Indian financial sector through a financial sector-specific cyber security strategy. And currently the work is on, and we expect that early part of the next calendar year that the draft strategy should be with us. As regards climate risk resilience, all the regulators and the government should work together in developing a comprehensive and consistent framework to identify, assess, and monitor systemic climatic financial risk and adaptation measures. The latter is fairly important or are the centerpiece for our developed economy. The objective should be to ensure that effective management of climate-related risks and opportunities should promote long-term financial stability without compromising on the nation's development aspirations and priorities. Here, at the same time, regulations may have to move in tandem with and not being ahead of the policy. Another facet of interregulatory coordination is the joint regulation of financial products, like joint regulation of exchange-traded currency derivatives by RBI and SEBI, and joint understanding on regulation of electricity derivatives between Central Electricity Regulatory Commission and SEBI, leading to introduction of electricity futures in July 25. The joint regulation of currency derivatives ensures coordination on policy, risk management, eligibility criteria for exchanges, and market surveillance, particularly for products involving the Indian rupee. Coming to insurance sector in particular, a significant regulatory gap, at least from the insurance sector's perspective, is the voice of public at the stage of regulation making. And I'm just introduced, so Mrs. Raj Lakshmi here, who has been talking for years in that particular domain. While views of the insurance industry gets well articulated, we need to find ways to bring in expectations of policyholders, both current and potential, in a more structured and extensive manner. Another significant regulatory gap relates to health insurance and services. The health service providers are largely in unregulated space. The relationship between the health insurers and health service providers is through commercial contracts, which are in need of better structuring and a better equilibrium. Before closing, I would like to mention one more piece in the regulatory architecture that is a work in progress, and that is a National Financial Information Registry that can facilitate immensely in improving efficiency of credit products. Thank you very much for your patience.
Good, sir. Yeah, thank you. Good morning, everyone. The event host and the chief architect of the forum, Mr. Damodaran, Chairman EDI, Shri Ajay Seth, Chairman PFRDA, Shri Raman, the whole-time member SEBI, Mr. Kamlesh Varshni, and other distinguished guests, colleagues, ladies and gentlemen, a very warm good morning to all of you. At the outset, of course, as Mr. Seth said, we are all here for the highest regard that we have for you, sir. Thank you for getting us here. We all have grown up listening to your speeches, and speaking in front of you is a privilege. And then through this masterstroke of getting four of us on this forum together, you have got a de facto IRF of the FSDC, which Mr. Seth referred to. So the Interregulatory Forum, de facto. I'm really pleased to be here today for the 10th edition of the Gatekeepers of Governance Summit. as conferences like these provide an opportunity or these platforms are invaluable platforms, if I may say so, for the stakeholders to articulate and understand each other's perspectives. I thank the organizers for this wonderful opportunity. Our theme today is simple to ask but hard to answer. Regulatory gaps and overlaps, do they exist? I think the answer looks very familiar to all of us, but we will try to answer. Most organizations, as we all know, having spent 3-4 decades in public, we all know that most organizations often respond to governance questions by redrawing the organization charts, tweaking the reporting lines, and updating committee charters. This is what the normal response that we all do. These fixes do help, but only to a point. So the business models, technology, and vendor chains change faster than boxes on a slide. As firms expand, digitize, and outsource, and integrate, two patterns keep showing up. One is overlaps, two teams or two regulators asking for the same thing, and gaps, a new product, a partner, or a data set sitting outside or at the perimeter of any policy or regulation. If we keep editing diagrams without analyzing the root cause, we treat the symptoms and miss the cause. In my view, the reason is intent. When intent is strong and governance is lived in spirit, overlaps simplify and gaps close. When intent is weak, the reflex is to add more rules and procedures, multiplying work but losing sight of the real risk. The real question is how deeply good governance is internalized in everyday decisions and board oversight. So because we have a large number of people who are all part of the board process, so with what lens we should see is what I was trying to put. I thought I will put this into 5 practices that we all may adopt, or which matters the most. Number 1, boards must own outcomes, not paperwork. Number 2, independence should be in substance. Number 3, look through the group, not just an entity. 4, protect and empower the control functions. And 5, governance gap analysis with real remediation. Let me briefly elaborate on each of these 5 aspects. Firstly, boards must own outcomes and not paperwork. A diverse and independent board keeps an organization on track by overseeing compliance, risk, culture, and ethics. Directors must exercise their duty of care and duty of loyalty, and they must own outcomes. Boards must set risk appetite and outcome goals and require independent assurance, risk compliance, and internal audit to test what matters and report findings, root causes, the owners, and the closure dates. Secondly, independence is not a label, it's the ability to challenge. It's a posture backed by time, information, and courage. Independent directors should be able to challenge strategy, controls, financials, and risk, and to question the assumptions behind the forecast. Our anonymous 2024 survey done by RBI, our anonymous survey 2024 amongst the boards of banks revealed that many boards prefer consensus, and a meaningful minority of directors hesitate to voice dissent. The chair's role, therefore, is to draw out quieter views and keep challengers safe. Thirdly, in large conglomerates, risk does not stop at the boundaries of individual entities. Boards should see the whole and not just the parts. 2 steps help. First, ring-fence critical entities so a local problem does not become a group crisis. Second, enforce strict related party policies. Such transactions can be legitimate, but they need transparency, fairness, and arm's length terms. Sound rationale and good documentation are evidence of thought and a tool for future learning but not a bureaucratic burden. Fourthly, the 3 lines of defense must be real. Business lines own risk. The risk management and compliance provide challenge and guardrails. Internal audit tests the system independently. The heads of assurance functions, as you all know, the CRO, the CCO, and the head of internal audit must have access to the board and to any business line that can create material risk. They should have adequate budgets and full access to information. Decisions on their appointment and removal should rest with the board. Weak lines of defense are a board failure, not a staffing glitch. An anonymous supervisory survey again among the assurance head that we did last year found that while most reported strong board backing, but almost half said resources do not match their banks or institutions' size and complexity. It's essential to give assurance heads independence, stature, and adequate resources. Otherwise, assurance stays ornamental. Finally, markets move faster than rules and regulations. A periodical governance gap analysis helps organizations to see where their policies and frameworks stand against industry best practices, spotting weaknesses, strengthening compliance, and improving risk management. So for a system-wide perspective, we all know modern business is not tidy. A listed company can be a part of a conglomerate with banks, NBFCs, insurers, brokers, payment firms, tech subsidiaries, overseas arms, and associates. The regulatory map is equally rich. You have company law and MCA, securities regulation, and listing rules, sectoral regulators for banking, insurance, pension, competition law, insolvency, accounting and audit oversight, market conduct, data and cyber requirements, and multiple enforcement agencies. Add international obligations, exchanges, depositories, SROs, and state-level authorities, we have too many. In such a world, some overlap is inevitable. That is not a bug. Overlaps can also act as layers of safety net, ensuring that if one control misses an issue, another may catch it. The real problem may therefore arise from conflicting rules, duplicated compliance, and uncoordinated enforcement, which is avoidable. At the same time, new activities, new technologies, and new business models can fall between the cracks. So, we do agree both overlaps and gaps exist. The task for regulators is to work together, minimizing harmful overlaps and closing material gaps without choking innovation. In that spirit, let me offer 3 principles, supplementing what Mr. Seth already said, 3 principles, aspirational maybe in parts, for optimizing overlaps and gaps. Firstly, regulators must balance entity and activity-based regulation. Regulate the activity wherever it happens and keep stronger rules for entities that hold public trust. If an app offers investment advice, the advisory guardrails should apply, even if the provider is not a traditional intermediary. If 2 activities create the same risk, they should face the same rules, regardless of the label of the provider. The second principle is proportionality. Regulators should scale requirements to risk and complexity. A small, simple firm should not bear the same burden as a large, interconnected group. Systemically, important players should meet higher capital, liquidity, control, and disclosure standards. Proportionality keeps oversight credible and optimal. The third is to strive towards outcome-based regulation calibrated to market maturity. Where feasible, draft and apply rules to protect outcomes, fair customer treatment, resilience, true and fair financials, rather than looking or locking the processes or technologies. For instance, whether onboarding is on paper or biometric, the test is the same. Was the customer identified correctly? And was consent captured properly? However, calibration matters. Outcomes-based rules work best when supervision and enforcement are strong and markets are mature. So in conclusion, addressing regulatory gaps and overlaps is a journey of continuous improvement that demands constant reflection, adaptation, and courage to challenge the status quo. I have covered my speech broadly into two parts. One is that as to what the boards can do, and second is what regulators could do. The point that I'm trying to make is that the gaps and overlaps do exist, we acknowledge, but when the intent is strong, the gaps bridge, overlaps simplify, and governance transcends mere compliance to become our shared conscience. Thank you. Jai Hind.
A very good morning to all of you. I must repeat, but it's always nice to repeat good things. So we are here because we have worked with you, learnt under you, and thank you so much for having me here. Very good morning to my fellow speakers, ladies and gentlemen. So I just wanted to share a few thoughts that have over time come into my mind. I'm sure all of you are equally in your own experiences. You've already figured out where are the gaps and the cracks and where is the overlap. But I've had the fortune of having worked as a regulator at SEBI, and much of the time I was in surveillance, and then I handled what is known as the Market Regulation Department, where we wrote some seminal regulations, including the SECC as it stands today. And therefore, one has seen a fair amount that transpired during those 6.5 years that I was there. In fact, what Mr. Seth was talking about, the genesis of the FSDC itself happened at that point of time when there was a regulatory overlap, if I may say, or a regulatory sort of clash, if one were to go to that extreme, between the products that were overseen by SEBI and the product overseen by the insurance regulator. And this was actually something that finally led to the creation of the FSDC. So, we are all very clear that, if there are regulatory overlaps, most certainly, and they play out in their own unique ways in our regulatory architecture in the country. I further had the wonderful experience of setting up the information utility where NESL, as an information utility, was the regulated entity of the IBBI. So I was on the other side of the fence, and I had the fortune of having as a regulator my ex-boss and friend, Dr. Sahu. But that, of course, did not give me any additional advantages at all. And we went through a phase where we built a particular facility called the Information Utility, which holds all of India's financial debt. Today it's about 240 lakh crores, which is held there as evidence, digitally signed by both parties. And this led the company called NESL to innovate, and today we have got innovations that are there in the market, which are known by e-bank guarantee, digital document execution, and those innovations happened completely outside of regulation. In fact, somewhere I feel the way we went about innovating and creating those products because we felt the banks were going to benefit from it, but we had no locus, no regulatory support in doing so, and that's when further regulation got written. And of course, then I came into SIDBI. We did not know whether we were fully regulated by RBI or partly by RBI, partly by government, and we had an act in which we could write regulations for ourselves. So, it was, as an All India financial institution, one of those, creatures which have been created for a specific purpose to solve for a big problem that has been observed in the country, and therefore Parliament, in its wisdom, passes the Act, provides certain rules and regulations, and powers to make regulations, which I think SIDBI and NABARD still enjoy. So it has been a good journey, and therefore many thoughts that go along. And I wrote it down on a piece of paper, and I sort of thought I'd share with you what I think are gaps and overlaps, and let me just share that with you. Gaps emerge when innovation outpaces regulation. Overlaps arise when regulators act prudently to ensure no risk goes unregulated. So this is really where I understand that when we have an industry which is full of creating products, is serving the customer's need, is trying to take forward in the spirit of the Act the different services that are needed, but regulation can never a priori account for all those services and all those products which may be needed. And that is why even in the theory of regulation, we have the concept of a regulatory space which is co-owned by the regulator, by the customer, and by a series of intermediaries. And that is why the whole concept of regulation has today become a subject matter of deep study and large and widespread thought, where how is it that we can make it easier and better for all the actors concerned to be speaking to each other on a continuous basis, to be able to swiftly bring in changes, regulatory changes, and to be able to allow for regulators to give the freedom to the intermediaries and the market players to create new products. And therefore, things like sandboxes, which now have become very popular, and the RBI has done a great job in making that happen. At SIDBI, I was one of the beneficiaries of putting a product called GST Sahay into the sandbox because we didn't know what that really meant. It was meant to be a working capital product, and it is entirely based on the GST returns of a small business, and therefore you give working capital based on the scores that emerge by running algorithms on the GST and the current account. So, this is really where new products are getting created by persons or entities which are not giving working capital. Working capital is given by banks. SIDBI was not meant to be giving working capital, but there was a felt need that we need to have a working capital product. So this is where I think we've seen a lot of innovation, a lot of positive movements where the country has got, let me say it's got completely into the whole regulatory framework and is allowing for a very, very vibrant and productive interaction. Another thought which comes up, and this is really on chit funds and collective investment schemes. Now, is this a gap? Now, you could argue that yes, it's a gap, but it's a gap because it's not in the formal financial sector. Now, when we people in this room talk financial sector, we think it is the financial sector regulators, and therefore we don't consider the fact that chit funds are regulated under respective state acts. But we tend to compare that why is a chit fund risky and a bank account is not risky and an investment in a stock is not risky. A chit fund is deemed risky. And we've had enough schemes which look like chit funds, probably are not chit funds, were never regulated. We have the Sharda, the Rose Valley. These are names that, sort of were household names at one point of time. And all were created to extract money from innocent customers. And at one point of time, what was seen as a useful product to those customers ended up becoming a measure and a way of decamping with money. And this is really where we need to ask ourselves that why is it that chit funds do not receive the level of more detailed regulation and the guardrails that are probably needed? which we have seen in what is more known as the formal financial sector. So there is an interesting aside on this, and one of the startups which I happened to come across during my stint at SIDBI, these guys were actually creating a risk profiling of small customers where they were encouraging them to run chit funds on a digital platform. So it once again tells you that the way we are sort of moving ahead, and this is something which nobody has really gone ahead and looked at it from a regulatory point of view. It's one of those innovations that keep happening in our market, where because you have run through several rounds of a chit fund, and it really runs with a group of 10 people coming in and closing a chit fund anywhere between 1 week to 6 months or 10 months down the road. And therefore, because you have gone through so many cycles, you know that somebody is a player with this kind of behavior and somebody else is probably more risky, and therefore a risk profiling happens. And this is the kind of results that can really help even the traditional lenders to understand, okay, we have these risk profiles, this is useful in the way we can do our credit underwriting. So we have a situation where so-called under-regulated products, and when they are infused with a good proportion of technology, it ends up becoming something which is even more useful for the banks, which in their traditional methods could not have probably thought of or have had the access of the data. So then it really takes me to the whole concept of fintech lending, which I saw while we were sort of operating both with the small businesses as in SIDBI, and also through the SIDBI fund of funds, we were putting in money into AIFs, which were then funding a lot of these fintechs. And the single biggest issue that came about was, can a fintech lend? I mean, that was really the big question, which finally RBI sort of brought in several guidelines and rules and made it much clearer to all of us. But this was the sort of earlier days in sort of 19, 20, 21, in that phase. They were probably all under a Money Lenders Act. And that is the other great part, that we have a plethora of acts. Some are central, some are state, some are, on the concurrent list. And therefore, we have a situation where it's difficult to say something is entirely not regulated, and therefore it is weakly regulated. Now, that weakly regulated served everyone's purpose very well, till we found that customers and clients were sort of losing money or getting fooled with schemes of fraud. But when it comes to fintech lending, you have a complete audit trail. And the question therefore becomes, can the fintechs bring in that power of fintech-based lending into the traditional, well-regulated entities? And I think today when we speak, looking back at the last 4 to 5 years, we probably would unanimously agree that all banks are probably fintechs. In their own way, we have seen the digitization sweep through all the banks. I mean, the capital market entities, I think, were already fintechs many years ago. So it's very interesting to find how innovation with the benefit of tech has gone ahead and led to a possible gap, but then as we see, it does get covered in a reasonably short period of time. We also are quite aware that there are silos, and these silos, so-called, happen between the regulatory bodies. And I think the only reason why these silos happen is because there is a super specialization in each particular area. I mean, the capital markets in 2010-11, I remember we were plagued with algos, and we did not know what to do. We actually started put out a circular saying that if you put so many orders per second and if it exceeds a particular number, you'll get penalized. I mean, that was the only reaction as a regulator that we thought was prudent, because we wanted to reduce the number of algos being used for trading. Today, I think the entire market is trading only through algos. Individuals are running algos, which are thankfully well tested. So there is an entire arena of regulation which deals with algos and how they are to be tested, how they are supposed to come onto an exchange platform on a test bed to be then properly vetted, and then it can come forward and then you are allowed to use it. So we've seen the innovations, we've seen regulatory reactions to innovations, and then we've seen a more rational, long-term, long-serving policy which then sets in. And that is really how I think we are going to continue to see this, because it's impossible to stop and check the need for people to provide services and products which are useful to the larger world. In the pension space itself, I mean, it's a space which is, not that sort of vibrant as capital market, but we have a concept of a gap. Now, this is really a question which came to my mind, that is coverage also a gap? And my answer would be that if I were to look at regulators from a development lens, and some of us as regulators have the word development very clearly written in our names, I think the fact that we have failed to cover the large swathes of people in this country with a particular product is certainly a gap, and it is a regulatory gap, because there is a mandate for you as a regulator to be able to bring forth a set of products which probably we have not been able to do, especially I'm speaking as in the pension sector. I mean, we've got a wonderful set of products for the government employees. In fact, if some of you would have been sort of following it in the newspapers, we have a unified pension scheme which has now come on the heels of the national pension scheme for government employees, and it actually brings about a brilliant a median between the old pension scheme and the national and the national pension scheme, where it allows for pension payouts to happen much on the lines of an inflation-indexed pension payout, which was known as the old pension scheme. And all this has happened within the existing set of regulations, which was actually backed by some serious modeling and calculations and projections which was done between PFRDA and the Ministry of Finance. And somewhere the whole concept of pension payouts using UPS, which of course has a government guarantee at the end of it, but it is one more great innovation within the pension space. And therefore, the real challenge that we have put to ourselves at PFRDA is, how do we make sure that we have a UPS equivalent for the private sector? I mean, why would not everybody in this country want some kind of a market-linked guarantee which is built into their pension, which is at least giving them an inflation-indexed pension stream for a period of time, need not be all the way to life. So this is something which we've already thrown up, and therefore the need to bring innovations into the pension sector is something which is now regulation-led or regulator-led. And sometimes it's very good that the regulator also comes forward and sort of creates or engenders the innovations that are needed in that particular sector. So it is really from the lens that we see it, we know what is a gap or what is an overlap. And sometimes the overlaps are really, and as the earlier speaker, Mr. Seth, talked about the currency derivatives. Now the currency derivatives were created so that there would be a flourishing market for interest rate futures and for the currency derivatives. Both of these markets were created about the same time, and both have this interaction between SEBI and RBI. And somehow, has there been enough participation in that? Has that market been as vibrant as, say, the equity F&O market? That's really when we need to look at these innovations and see what further is needed. I remember another very important innovation that was brought out was the securities lending and borrowing mechanism. Somehow, I'm not sure where exactly it is, but it never really took off. It was meant to be a sort of, replacement or a digitization of the Badla system, but it never really took off. So it's very helpful for the regulator also to sort of go back and see what were the innovations and where are they standing as of now. So regulatory gaps directly impact financial consumers. And when oversight is blurred or delayed, we have the consequences of mis-selling, fraud, and a host of grievances that get thrown up in the system. We have, in fact, very serious problems of the lack of proper processes within a particular regulatory system, leading to unintended consequences where there is an entire business that has got set up under the regulations of the EPFO, where because people are unable to track their numbers and get their withdrawals from the system, we have great business practices that have come up, and there are a bunch of very innovative companies that are providing this help to the customers and making a sort of, a good service out of it, purely because there is a lack of process and a lack of due diligence in that entire system which deals with the Provident Fund. And finally, let me just sort of talk about, how AI and the kind of changes that are happening. In fact, it's wonderful to see RBI coming out with what's known as a free AI framework, which is really looking at how cross-sectoral regulation can happen when we are all in a phase where AI is sort of on top of us. And that's the kind of inter-regulatory coordination and cooperation that is really needed, because it's only then when the silos sort of dissolve. We can also have a understanding of where we are vis-a-vis the IFSCA, which is the only regulator in India which is cutting across all the regulatory spaces. It's a single regulator for a particular jurisdiction, which is the IFSCA, but it actually does the job of all the regulators in a single place. So, that's another very good experiment that we can see how gaps and overlaps can get reduced within the regulators within the domestic space. So I think I've taken up a lot of time. I will just put a rest to what I have to say, but thank you so much for hearing me patiently. Thank you.
Namaskar and good morning, everyone. It's really a privilege to be in the company of all such stalwart of financial regulation, Seth sir, and also Swaminathan sir, Raman sir, and above all, I think we have a lot of alumni from SEBI here, those who have worked in SEBI, with Damodaran sir as the chairman. I think the kind of legacy he has left behind in SEBI, we should call him Bhishma Pitama of SEBI. People will come and go in SEBI, nobody is permanent, but the thought process that he has left behind is going to remain forever. And it's good to see that even after his retirement, he is so actively involved and keeping all of us engaged and bringing out new topic like this topic, regulatory overlaps and gaps. So first of all my four previous speakers have spoken a lot and have covered most of the spectrum that you wish to cover. So if I am going to speak anything, I'm sure there will be a regulatory overlap with what they have spoken. So please excuse me for that. I will try to see that there is no gap left behind, only 7.58 minutes are left. So I will try to cover in that. Okay. So, FSDC has been spoken about. That's a very good council for reducing these regulatory overlaps and addressing the gaps. And we have seen how successful it has been. I think one example that I will like to give is a classic example of how government is taking initiative to address these concerns. In fact, what Seth sir has said in the beginning is the main takeaway from this conference is there would be regulatory overlap, there will be regulatory gap, but how do we address them effectively? That is the main point. And the classic example of how government has addressed regulatory overlaps in KYC through CKYC KR is a classic example. We know in security market we have KRAs. They have been very successful. You do KYC with one security market intermediaries and it is transported to another one. You don't have to do KYC again. But is that enough? No, because one citizen of India does not deal in security market alone. He also goes to a bank. He also goes to insurance service provider. He also goes to provident fund provider, pension service provider. So we have to address all these. So this noble concept of CKYC KR, which is taking shape, is that you do KYC with any financial service provider once, and then it is transported to everywhere. So this is a classical example that yes, there are regulatory overlaps because each regulator wants you to do KYC, but can we effectively address them? Now, taking from here, can we think for the future what we already have done successfully in security market, consolidated account statement? We all know as an individual how beneficial that statement is. It puts all our security market holding at one place. It helps us, our legal heirs, our nominee, to inherit those properties without any hassles. They don't have to search, after a person passes away, which bank he has account. Legal heirs don't even know. But CAS is one consolidated statement in security market which gives all asset at one place. Can we have this scope of this be extended to include all financial assets? I think that is something which will be another example, successful example like CKYC KR. Now coming to specifically what we have, we have spoken a lot about regulatory overlaps. In the context of SEBI, normally regulatory overlap people often complain is with respect to Companies Act. Like we have our provision in LODR, companies have to follow certain things, while Companies Act also mandates. And it is often a feedback that there are regulatory overlap. LODR is more restrictive, requires more compliance. Just to illustrate, let's see the board composition. While Company Act says 50% should be independent director, and 1/3 should be independent director, but LODR says that if your chairman is an executive chairman, then 50% should be independent director. So how do we address this regulatory overlap is that if you comply with LODR, you are already in compliance with Companies Act because Companies Act says minimum, so you can have more. So same provision is there when we talk about composition of audit committee and composition of nomination and remuneration committee, because Companies Act says that 50% independent director, but LODR says 2/3 independent director. So if you have to have 2/3 because you have to comply with the LODR, you are already complying with Companies Act of 50%. The question is why they should be different numbers. Ideally, I think this is for the reason that Companies Act is for all type of companies, whether they are listed or unlisted. But in case of LODR, it is listed entities, and because it is a listed entity, they are public shareholders, so their interests have to be protected. So therefore, you will find these requirements be slightly different from the requirement of Companies Act. But it is not that that LODR requirements is in conflict with Companies Act requirement. Because when you comply with LODR requirement, you comply with Companies Act requirement as well. But the basic thing is, what is the purpose of having these independent directors? I think this point was also touched upon by Swaminathan sir, that independent directors should be able to challenge. So that is what, is that happening in the board meeting? Is that happening in the audit committee meeting? So these are the things we need to probably address. At the same time, there are feedback from independent directors that we are also not sure what is our functions, what is our responsibility. And we often find that if there is a violation by the company, we are also issued summons, we are also issued show cause notices. So that is one area also we have to address, because we want good people to come as an independent director. And if we have if this is not clear that what responsibility they have to fulfill, that you will find good people not willing to come forward as independent director, and we will not have quality oversight in these board meetings. So therefore, as a regulator, it is our duty to provide clarity in the role of independent director, and our expectation from them is that in substance, you perform the role of independent director. So these are the challenges that we have at present, and I'm sure that with the cooperation of everyone, we will surely address these challenges. Similarly, in RPT transactions, there is a lot of difference between Companies Act and LODR. What is RPT? Once again, Companies Act definition is narrower and LODR is wider. Same is about material RPT. Same is about approval in audit committee, while LODR says that only independent director should approve RPT. Once again, the reason is simple, that Companies Act is dealing with both listed and unlisted entities, and LODR is dealing with listed entities. So it is important that we ensure that, because RPT is one type of transactions where transparency is required, to give assurance to minority shareholder, public shareholder, that things are happening in the company in a professional manner. I think most of us are, probably all of us are civil servants here. So when we join civil servant, first thing which is taught to us is, you should not only be fair, but also appear to be fair. So it is that appearance, transparency, which is extremely important, that the message is given to the public shareholder, minority shareholders, that even though you don't have control over the company, your interests are taken care of. So these provisions that we have in LODR may appear to be regulatory overlap with Companies Act, but they are there to serve a particular purpose. But let us move from regulatory overlap. Can we, through administrative measures, address these overlaps? Now that is again coming down to the same point which was first raised by Dr. Seth, that how effectively we address these regulatory overlap. So idea is to provide ease of compliance to company. Maybe there are different requirement under the Companies Act, different requirement under SEBI, but can we have a ease of compliance? So we are taking steps in that direction. Like we have a common, right now companies were required to file, suppose a company is listed with NSE as well as BSE. So it is required to file duplicate reports with NSE and BSE. We have addressed that concern, and to a large extent, they now have to file only at one place. Some more work is required to be done here, but within a few months you will find that it will be fully achieved and they will file their report only at one place. So this is one step forward. Can we take it further and have some kind of a concept like annual information memorandum? That is just a thought process. Nothing has happened in this direction. But the thought process is that if we can have a company filing annual information memorandum, which not only contains LODR information, but also Companies Act requirement. Of course, we have to work with the ministry in this direction. But if we can have that kind of an annual information memorandum, not only it will be an ease of doing compliance for all these listed companies, that they have to just file all information at one place. They don't have to do it again and again. It will serve more than one purpose. First of all, there is currently information arbitrage between what we have in primary market and secondary market. And I will explain how that will be addressed. Because one, you have information, annual information memorandum, which not only has LODI information, but ICDI information as well, which you file when you file prospectus. Now, if that information is also included in annual information memorandum, your future public issues will become very convenient. Because then you don't have to file that prospectus again and again. Everything is already filed in that AIM. Probably only small information like what is the object of issue and all that you may have to file. So this is one thing which is currently only at a conceptual thought stage that can be, through administrative measures, address these regulatory overlaps and provide ease of convenience to the companies. Gaps, talking about gaps, a lot have been spoken. Gap is essential because as Raman sir, says that when innovation outplays regulation, there would be regulatory gap, and that is what has happened. Sets are addressed about cyber security, climate risk, all those issues which are very much relevant, and where a coordinated effort among all regulators are already being taken to address these gaps. Another issue probably which could demand attention of all regulators in future is crypto. This is also one area probably in future we all regulators have to come together and address these regulatory gaps. And then another area which probably could be about regulatory gap is that while we have boards and board committee in listed entities, do we have a mechanism to review their performance? Similarly, like what was said yesterday, that do we have a mechanism to review the performance of regulators? So, good idea, and probably yes, we should have a mechanism to review the performance of regulators as well, and we should have a mechanism to review the performance of these boards in the company. Because ultimately, we all are working in a fiduciary capacity, and we should be answerable to whatever actions we are taking. My last point is on something which is troubling everyone right now. And I am not saying it's a regulatory gap, but it is something food for the thought. That is whether the valuation that is being carried out at this point of time is correct or not. We have seen a lot of IPOs are coming where retail investors are challenging the valuation. SEBI has taken a step which I think is the right step. We have moved away from control of a capital issue. There is absolutely no justification to go back to that kind of system. Valuation should be determined by anchor investor, which is happening right now. This is the correct methodology. Now, we think that when anchor investors are doing valuation, SEBI should keep itself away, which it is doing, and which probably is the right thing, but without compromising on this position, how do we ensure that valuation by anchor investments are also taking place properly, effectively, efficiently? I think that is something we need to talk about. That is one point of valuation. Another point of valuation where SEBI is involved is valuation during corporate arrangements. You must have seen few interim orders. There are other cases that we have seen where corporate arrangements are taking place and promoter shareholder probably get valuation at an inflated price to get a better swap allocation, which is to the detrimental of minority shareholders. And lot of complaints we are receiving from these minority shareholders that their interests have been compromised. So this is one area probably which is something which I feel not in the IPO area. IPO area is not a regulatory gap, but we have to see how we can further put guardrails. But in corporate arrangements, valuation is one area. Can we provide guidelines for valuations? The way there are guidelines in transfer pricing. So maybe this is one thing probably we may have to work with another regulator, IBBI. So this is another regulatory gap, in my view, probably we may have to work for in future. So this was just my idea on this topic. Thank you very much for your attention. Jai Hind.
So thank you, Mr. Seth, Mr. Swaminathan, Mr. Raman, and Mr. Varshni for sharing your insights with us. May I now request Mr. Damodaran to please present a memento to each panelist. On behalf of each panelist, Excellence Enablers is proud to have sponsored education for one girl child for 1 full year through the NGO Nanni Kali, a Mahendra initiative. Well, it's a collaborative initiative between KC Mahindra Education Trust and the Nandi Foundation, dedicated to advancing the education of underprivileged girls in India. The project offers academic support, life skilling training, and essential resources to girls from low-income families, enabling them to complete their schooling and in equipping them with skills, including financial literacy and digital proficiency. Thank you, Mr. Damodaran, for doing the honors. Request all of you to kindly come closer for a group picture. Once again, thank you to all our speakers for that absorbing session. We shall now have a short tea-coffee break. Tea and coffee arrangements are made right outside the hall. Request you all to kindly be back in time so that we can start the next session. Thank you. Inclusion and Development Department, Inspection Department, Premise Department, and Raj Bhasha Department. And prior to that, he was the Managing Director, Corporate Banking and Subsidiaries of State Bank of India, SBI. In a career spanning over 34 years with SBI, he has held various assignments across corporate and international banking, retail and digital banking, finance and assurance functions. Ladies and gentlemen, may we request you to kindly take your seats so we can start the next session. Requesting all our guests to kindly take their seats so we can start the next session. हमारे जितने भी गेस्ट बाहर हैं उन सभी से गुजारिश है कि वो कृपया अपनी अपनी सीट्स पर लौट जाएं ताकि हम हमारा अगला सेशन समय पर शुरू कर सकें. थैंक यू. May we request all our guests to kindly take their seats, please. Ladies and gentlemen, our speakers are ready and we are all set for the session. We're just waiting for all of you to settle down, so may we kindly request you to please take your seats. May we kindly request all the guests to kindly take their seats, please. So welcome back, everyone. Our next session is Risk Management Committees. Have they come of age? The Risk Management Committee is a latter-day addition to the list of committees. They have gained increasing attention in recent times. Are they doing enough, or is their suboptimal performance a risk in itself? We have with us our panelist, Mr. Ashish Kumar Chauhan, who is the Managing Director and CEO of National Stock Exchange, which he helped to form and where he worked from 1992 to 2000. Prior to becoming MD and CEO of NSE, he served as the MD and CEO of BSE from 2009 to 2022. He is known as the father of modern financial derivatives in India. He credited with setting up the first screen-based trading in India, mobile trading, mutual fund distribution through exchanges, markets for SME shares, satellite telecom, the Nifty index, equity derivatives trading, and many other modern developments in the Indian stock markets. He is a member of University Grants Commission and the Chancellor of University of Allahabad. He is on the board of IIM Kolkata and Open Network for Digital Commerce, ONDC. He was also involved in conceptualization of the National Securities Clearing Corporation, NSCL, and the initial setup of National Securities Depositories Limited, NSDL. He is a member of the University Grants Commission and the Chancellor of University of Allahabad. Ladies and gentlemen, Mr. Chauhan. Our next panelist is Dr. Shobna Kamineni, who is the promoter, director of Apollo Hospitals Enterprise and executive chairman of Apollo Health Company and Apollo Pharmacies. She has spearheaded significant initiatives, including the development of 3 of the largest verticals within the Apollo Group and the leadership of India's largest integrated digital healthcare platform, Apollo 24/7. She was the founder and chairperson of Apollo Munich Health Insurance, later divested to HDFC Ergo. She was the first woman president of Confederation of Indian Industry, CII. She has been a very active in not-for-profit space relating to health initiatives and has founded Billion Hearts Beating, an NGO promoting heart disease prevention in India. Ladies and gentlemen, Dr. Kamineni.
Doctor.
Our next panelist is TV Mohandas Pai. He is a chairperson of 314 Capital and RN Capital. He has helped launch over 14 different funds in venture, growth, and public markets. He is also the co-founder of Akshay Patra, the world's largest school meal program for students. He works actively with government and regulators on policy, recommendations, and guidelines. He has served on the boards of SEBI, the National Stock Exchange, the Manipal Group, and many other institutions. He has served on several regulatory and consultative committees, including the Primary Markets Committee of SEBI, several IITs, and the CAFRAL of the RBI. He is a former CFO and board member at Infosys. Ladies and gentlemen, Mr. Pai. Mr. Pai will also be the moderator for the session. Over to you, Mr. Pai.
Thank you very much. We'll dive in straight away. This is about risk management committees of corporations. We know that SEBI has asked 1,000 top companies to have risk management committees because business is about risk management and the ability to earn superior returns on a risk-adjusted basis. And it's very important to understand risk in a fast-changing environment. So Ashish, let me come straight to you. How do you see this whole idea of risk management committees? Have you found it useful in NSE? Have you found it useful in BSE if you had one? And looking at risk management committees of companies listed on NSE, how do you see them progressing in this area?
In a way,
risk, I mean, of course, NSE has set up a risk management committee, and it is quite useful in terms of formalizing your thought process. It starts asking questions to the management on a variety of things. But overall, in BSc too, but overall, the way I look at it is, once you set up a formalization of a framework, it also becomes a tick boxing exercise in a way, that otherwise the committee members would be asked later on, did you take look at this risk, that risk? And as you rightly said, what is risk? It's an interesting sort of concept. That risk comes out of an Italian word called risicare, R-I-S-I-C-A-R-E. How they pronounce in Italy, I don't know. But it means to dare. In fact, there is a book by Peter Bernstein called Risk Against the Gods. Because when you dare, you are in a way going against the God's wishes, right? And so for me, what is business? Business is basically the risk you want to take, you are good at taking, that risk you should take. And the ones which you are not good at taking, you should be able to identify and then pass on to somebody else. There is no way you can, all the risks in the world don't get eliminated. Why? Because, I mean, I am a professor. You might have seen in my CV also that I have more positions in education than in finance. And so I used to take 40-hour course on risk. Right? So basically for me, the way you assume risk, why does risk arise is because of the time. Risk is a function of time, right? And so on and so forth. And when the committees start thinking about the risk affecting the business, one is the business itself as a risk, which is the core part of the business, that it's taking risk from others, providing some services or products, and then what it doesn't want to catch. And external perception vis-a-vis internal situations also need to be checked out, because broadly speaking, you end up worrying about only financial parts or treasury parts, which is in a way very, very limited. Whereas what you need to be worried about is how companies actually stop now. In fact, one large company in UK recently closed down for almost 4 or 5 months now, just on information security going wrong, right?
Yeah.
And so government of UK has to now fund it for so many months. And so the risks, the unknown, see, again, the Dick Cheney stuff, you know, that there is a known, and then there is known unknown, and then you have a unknown, right? And so a good risk management committee will at least do known unknowns, but an excellent risk management committee will do unknown unknowns, right? And that's how, and it is true for countries, it is true for individuals, it is true for companies also.
Now, within your enterprise, what do you see the role of the risk management committee of the board vis-a-vis the role that management plays? The management manages risk on a daily basis, right? And especially for a platform like you in the stock market, risk is there every second. Now, you have a risk framework, you manage it. What role that the external board members play sitting on the risk management committee of the board?
No, at least they help you formalize your thought process. You need to create a framework. You need to go through all the ideas, because you will be grilled. Otherwise, you are managing as a part of your day-to-day job, and you don't write that down. You don't make a presentation to nobody, because you're running from really one crisis to another every day. But when you have to actually formalize, you have to report, you have to see how things are going right, going wrong, what could go wrong. And that's where I think the risk management committees actually play a very, very important role.
And they played a good role.
Absolutely.
And they tightened up your ability to manage risk and to focus on risk, evaluate risk.
Absolutely. And at the same time, see, for me, risk is a probabilistic function. But when the event arises, it's a probability equal to 1. Right? And then the committees cannot take you out, because committees are sitting somewhere. Ultimately, for me, unless I die, I don't go to heaven. So committees can't take me to heaven. Right?
Shobhana, now you are a doctor, medical.
No,
you're not a medical doctor.
Yeah. When she announced that, I was looking around the room. We have
Saying,
only
who is
one
that?
doctor in the family.
Okay, that's your father. Okay. Now, your father is a medical doctor. He understands risk in medicine, right? It's about handling patients, diagnosis, and all that. Now, you are a business person on the board. You've been chairman of the board. Now, how do you see the risk management committee of the board? Have you found it useful? Has it helped your enterprise to manage risk better?
First of all, I really liked your thing, the definition of risk. I obviously didn't follow it when I broke my foot. So I did challenge the
I told her
gods.
she's got one more foot left.
No, no, no. As cruel now. So I think, Mr. Damodaran probably called me because I also was involved for 11 years in a very, very risk-averse industry, which is insurance. And that's really where I learned, so much about risk. And once when I was talking to the chairman of Munich Re, and I asked him, what keeps you up at night? And he said, and this is like even before AI and cyber security and all. And he said this, so this ability to look across, oceans. And he said, what really worries me is climate, is about, climate change, is about the seismic shifts we're seeing in geopolitics, of immigration of people from one place to another. And then he spoke about cyber, and he said, we don't even know how to price that risk. And at that point of time, we were looking in health insurance, and you're pretty much in that kind of a field. Early in India, we were the second health insurance, company. And at that point, you really don't know what you're pricing for. You don't know what can happen. And I wonder, so one of the things is that I got paid out a month before COVID. So we sold it to HDFC. But did you see the risk of COVID that hits? That's when it really came to us about what health is and how you look at it. So this whole risk perception, when it comes down, and every day when risk is part of your DNA, and you're sitting and trying to challenge, you're trying to manage logistics, you're trying to manage the unknown of treatment. And so what we did is, you started looking more around the world. And I think this is interesting for risk, because if a risk manager is sitting just looking at his own internal, it will never work. If they just look internally into the business, it's his business to take not just a national view, but a global view of what's going on. And I think this is super important today for every board, every risk committee. Then I think the next thing that I've learned is, it's not about the 1,000 companies, but it's about the next 10,000 that want to be in that 1,000. You cannot just get into the 1,000 and start thinking risk. It has to be part of how you build companies, of how you're going to make capital allocation, how you're going to work this. So to me, I think that's an important takeaway, that we take it as part of us. And the third thing, which is again particular to our business, that came up in our board meeting yesterday, when an American board member, he asked, when we said, here is the risk framework and this thing, and he said, 94 might be okay for a company which is in manufacturing and all. Is it okay for healthcare and an airline company? That 6% might be the difference between life. So how do you look at that, and how do you put it into different parameters? And I think this is a change in what you do. So it's different industries that have to look at the way that the importance of risk, and if it's going to involve lives, or if it's going to involve things of reputation of big companies, or what are those that will seismically change you. I think that even like you said, that even that 1% or the 0.1% is 100%. So I think this is the thing of how risk is. So is it working for us? I think it is, because even an entrepreneur like me knows how important it is to be in this space today.
But tell me, what role does the board play? The board's risk management committee, they're obviously independent members, some people of management, etc. Do they have the level of expertise to question you, to advise you on potential risk? Are they just a sounding board? I mean, are you concerned about the lack of expertise, the need for expertise on the risk management committee of external board members? When you evaluate board members to join the board, do you also see whether they have the capacity to be part of the risk management committee? How do you see the board as a risk management committee of the board, interacting with you as management, and do you find the interaction useful, or is it just that There's a regulation. You need to have a committee. So you play it up, and they ask a few questions, that is over. How do you make them useful, and do you find them useful?
I'll give you an example. I got Advent in as private equity into our in the company that I chair in Apollo, and I thought, here we are. Most of it is supply chain, and we run so many go-downs, in the country, and we're the largest pharmaceutical distributor in the country. And they came back to us and said, 3 of your go-downs, you don't have a formal fire license. We won't invest. And at that point, we said, what are you talking about? It's not that bad. It's just that there's some problem with it. And we told them, in the technical, it doesn't go by the rule book. But they said, no, this is a risk. So I think when you have outside people and independents coming in, they have a different lens. So I learned something that day, and I think that's what the independent directors do. Not all of them might be experts in everything, and for that, we definitely have, we've hired a firm that actually sits and does the heat map and do this, but sometimes these independents will connect dots that we don't see, and I think that's what risk is about. It's not like you'll know everything, but how are you connecting those dots and bringing those synapses to something that is unconnected with you? These guys are not in healthcare, they're not in logistics, but they bring this in because it's the framework of that American doctor that came to us and said, how do you look at this risk is 94 doesn't work. So I think some boards have it. Now, some that are not, I can't speak for all boards in India and how they do it, but I do think that those that want to be able to prosper and really move forward in the future, if you don't look at this seriously, and Mohandas, you're so provocative that you're asking me this question about board members and all that. Tell me which entrepreneur loves their independence. But the thing is that they're there for a purpose. And I think the more they challenge us and push us in a good way, it's those are good discussions to have.
An independent board, we had discussed it with Mr. Damodaran, becomes important under 3 circumstances. There's a regulatory failure for the corporations, and you need a board member to stand up for the corporation. 2, there is a CEO failure or a management failure within, and the board has to take over. And I think 3, that the business failure because of external environment, like the global financial crisis, where the board has to stand up. Now, that's where I think independent board members become extremely important, because they have to protect the enterprise from management and the external environment. But the bigger question which I would ask is...
RPT also.
RPT. RPT is a structure, I would say is a structure, is a disclosure and a structure.
Our board spends a disproportionate
because a lot of disclosure there. But the question I'll ask you, as an entrepreneur and as a board member, as a founder of an enterprise, and as a person whose large part of the net worth is in the enterprise, do you actively look for and cultivate to have a great board in managing risk and becoming a sounding board, questioning you? Do you look forward to the questioning? Do you actively work to make them better? Do you actively work to look at the external environment and see what is happening? Are you paranoid about external risk just to make sure that you do not fall apart because something happens which you are not paid attention to?
So I think that one of the things that I am, if anything else, is paranoid. I feel that in this world, if founders, if CEOs are not paranoid, their business will become walking dead companies, because there's always somebody to disrupt them. So we need to be able to keep our eye on the ball. Whether our board members are in that space or not to be able to healthily challenge us, I think to some extent, but I get as much pull and discussions as in platforms, talking to you guys, or just meeting people, and I think that part of it. So I think that most people actively want to be able to de-risk themselves. It's a natural phenomenon of a person and for a company. For a good company, you're always looking to de-risk. So wherever you're going to get that better, and I agree, you keep, I'm going to go back and ask my board members to do more after the way you described it. But I think that it's all a work in progress. And the better that we get it will never be 100%. But the way that we look at it and approach it, and if you're going to go on every day with a fresh lens, I think that's one thing I would have learned from talking to you today.
Now, Ashish, tell me, how do you inculcate a culture of understanding risk in the enterprise? Because, you are a platform. You are in public scrutiny every single second. Anything could blow up in the world. And it's really scary. I mean, I've been on the board of NSE, and I've been scared sitting on the outside sometime wondering what happened. Because every time something goes wrong, at 9:30, the market doesn't open for 1 second, the whole market crashes, and then the SEBI is going to call up this and that. It's scary. It happened once or twice. Now, how do you create a culture of understanding risk, trying to take steps to make sure that as much as possible, the enterprise itself, the managers manage that? How do you create that culture?
In a way, you need to figure out and then rank them. There are
matrices and
there are
process.
Million risks which you can identify, and probably trillion which you can't identify. But the ones you can identify, you need to put them in some sort of a priority list. And as you rightly pointed, the biggest risk an exchange faces is that in the morning it doesn't start. Why? Is that once it starts, it's like a car, it will keep on rolling. Normally, it will not fail. But if it doesn't start in the morning, it's a chaos. I mean, UPI can fail 4 hours, nobody will. But somehow, in this country, we have created a perception that NSE cannot fail, which is a good and bad both. So I recall February 24, 2021, I was in BSE. NSE did not work for 4 hours. It was like, Amazon, that AWS, what they call it, last 3 weeks they have failed 4 times, where 80% of American websites are working, and still nobody cares. Its prices actually go up, because it shows that how many people are dependent on it. People who didn't figure, started figuring out, "Arey, ye to acha hai." Why I'm telling you this, when I joined NSE back after 22 years, in 2022, first thing I said, how do we figure and how do we ensure that this, to the extent possible, again, nobody's a god, to the extent possible, how do you ensure that this thing doesn't recur, right? And so I said, you are starting the market at 8:45 and you are blind, because that time things may go wrong, right? You are switching on and the battery of the car is not on, or it is drained, and suddenly you go to find Uber, which is not available. That happens, right? And so how do I do it? So I said, let's start. And it was just how COVID was just going off. World was becoming slightly normal. And so we said, how do we start this? I said, let's start testing from 12 a.m. in the night. That every 10 minutes or 15 minutes, you have to place an order, a dummy order. Other side, also you have to place a dummy order. It should match. Then it should go, after matching, to the ticker. It should go to the clearing settlement. It should go to the bank. It should go. So we have like 300 types of systems, right? So it has to go through all the systems. Like you are putting, when you do CT scan or MRI, you put that dye in your body, it starts showing. So every 15 minutes today, after I joined, and naturally employees were up in arms saying, boss, we come in the morning at like 7:30 earliest. You are making us do night shifts. Now I have 24/7/365. NSE never sleeps now.
Oh.
And people have, and there are 5 shifts, so there are overlapping 5 shifts so that people can hand over, take over and things like that. But as soon as the day end happens for the previous day, next day you prepare, take all the systems on, and then start ensuring. That doesn't mean that you still are leaving that delta, that small little percentage, but at least you have eliminated a large part of it.
As much as possible.
And the employees, because in COVID, we were allowing people to work from home. Now, the risk is that anyone having an access from outside for an institution like NSE could actually create situations which you cannot even imagine. Correct. Right? And so I said, no, now everyone has to, if you want to work for NSE, you have to work out of building, not from...
work in the building?
Yeah, not from home.
Not from home?
Yeah, so now people are used to not coming to office. So, and I was the first in India to say, no, everyone, whoever wants to work, of course, if you want to go, please go. But my operations guys, of course, if you're in listing, if you're in non-real-time stuff, you can come a little later, but my market starts now at 12 a.m. and not 9:15 a.m., right? So that's how you have to basically prioritize saying what is it that you want to do. And sometimes when I explain to students what is risk, right? And how do we measure risk? Have you heard of concept of volatility? Right, so volatility is not, many people think when I lose money it's risk, and when I make money it's not risk. It's not true. Right? It's basically, in mathematical, it's called x minus x bar, right? And so, if you are expecting to make 100 rupee profit and you make 1000 rupee profit, it's still risk.
Yeah.
Because what is risk is movement away from expectations.
Yeah.
So even if you make a lot of profit, it's still risk. If you make loss, you were expecting losses and you made so much losses, then there is no risk. Because away from expectations is zero.
Yeah.
And so unless you keep on telling your people, your board, that which are the priorities of our risk, how this keeps on happening, and still processes. For me, risk management committee is a part of the process. It will go through, it will ask you intelligent questions, it will check everywhere else what others are doing. But when it comes to risk actually fructifying, then you need to do action. You can't be worried sick like a deer stuck in the headlight, neither here nor there. So you have to keep on training your people, testing your people. So today, I have literally exactly the same setup in Chennai. If you, by whatever situation, if NSE is bombed in BKC, in 45 minutes time, it will be taken over from Chennai, but exactly same replica. One person sitting in NSE, BKC doing something. The checker, the maker is in Mumbai, checker is in Chennai. And if it's like they are working together.
Yeah.
And it's done in such a way that every month we do a mock trading from Chennai, but twice a year, at least 2 days, we do live trading from Chennai.
Yeah.
So that most of the time you have disaster recovery, which is there, just you think you have spent the money, very good. Tick boxing happens, but you have never tested. And it is not only in stock markets, everywhere. Only in India, stock exchanges are forced to trade from the DR site twice a year, and at least once a year, of course we do it on a Saturday, we do, these are planned shifts, right? On Friday night we shift, and then Monday we start trading from Chennai. But once a year, we try to actually run on Saturday real market, live market, not mock. And then create a crisis by closing down one machine only.
You deliberately create a crisis to understand.
And then it has to take over, because see, when you do machines shut down in a systematic way and take over from there, then you are not doing a real crisis, right?
But you're not doing in live trading.
Live trading we are doing on Saturdays, because I don't want to affect on Friday or other days.
Too much.
But why I'm doing this is just to say how prepared. So for me, how to stay prepared for your largest risk, because for me, that not starting or NSE not working in time is not only a risk of business, but it's also reputation risk. It's not only a reputation risk for me, but reputation risk for India, right? And it's other exchanges in the world keep on closing down. Chicago Mercantile Exchange, Nasdaq, New York, Singapore, everyone closed down. Only in India you cannot close.
They don't have a SEBI to push them and the fear of SEBI.
No, we have 7 television channels.
Huh? You have?
7 television channels doing work only on me. Now, that is the problem.
Good one.
Right? SEBI also would understand that somewhere, nobody is a god, right? And even, sometimes people tell me that you have to hire the best. They actually, some SEBI chairperson used to tell me, your CTO has to be earning more than you. And I said, Madam, आप Bill Gates को लाइए, फिर भी नहीं कर पाएगा. Because now the world has moved in so many different directions. I mean, it's easy for me to pay money and think that risk is gone. ऐसा नहीं होता. Right? So that's where
management.
You have to actively manage, and you can have all sorts of wonderful ideas about saying paying money means getting results. It doesn't work, right? Today you are going through AI, right? I mean, in morning I was in a panel.
No, I'm going to ask you on AI separately.
Right.
Okay?
So yeah, I will basically sort of dwell upon it at some point.
Yeah. But let me ask you then two questions coming out of that. In case a crisis happens for something, some risk gone wrong, what will be the role of the board and the risk management committee for the enterprise? And second question, what role does a regulator play for a regulated entity as far as risk is concerned?
See,
Two separate questions.
See, if
Start with the first.
If the risk arising is a slow-moving risk, it's like a slow-moving train track, then it's, at least the outsiders can see that train is going to go and hit somewhere. But if the event is happening, unfolding in rapid time, my risk, and I'll tell you, my response time is in 100 microseconds. 1 second has 1,000,000 microseconds. Next year, I'll give you response time in nanoseconds. 1 second has 100 crore nanoseconds, or 10⁻⁹ or a billion nanoseconds, right? In that, the difference between 1 second and 1 microsecond is the same as 1 day and 3,500 years, right? So, in that, what is committee going to do? What can I do?
Nothing. No.
So what I'm
fallout, no. You are to manage the risk. That is given. The fallout of the risk for the public eye, what role does the board play?
So the way I look at it, when SEBI thinks or some other people think that risk management committee is there to manage post facto or pre facto or plan. Unless you figure that, you are going to be thinking that committee will come. Now you try to call committee members when NSE stops functioning or some large broker defaults. You mean to say that person sitting in some other corner of India or world has any clue of what is happening or what is going to happen or what can happen? You wait for them because they are bosses. And boss has no clue how to respond. So you have to keep on doing. So we have a framework for a broker default, 2 of them largest brokers defaulting, what we will do, how much money I have. Every day I have to count. Literally, I get to count saying my top 2 guys, top 3 guys today, if they default all of them, simultaneously, I have still enough money in my settlement guarantee fund to ensure that my settlement happens next day. If all 3 break down, their investor protection, because some of the investors will not get money, I have enough money to give minimum some guarantee to even small investors like 2-3 lakh? So those are the things we keep on worrying, working, creating funds. Sometimes income tax does not allow that, saying you are trying to avoid taxes, right? Because you are allotting money for those kind of things.
What role does the regulator play for you as the regulated entity in terms of risk management, committee architecture?
So the risk management, basically the role the regulator has played is, they have gone to the ministry and saying this settlement guarantee fund, which is when the broker defaults, exchange has to pay up, you need to create clearing corporation, and that should be tax exempt. They got it done from ministry, and every time I have to send, when they create a framework for saying how much minimum I should keep. There is a regulatory capital, regulatory risk capital, and actually business risk capital, right? So I have to worry about regulatory, which is tick boxing, but I have to worry about the other side. But they got my approval from income tax, and each time I can assure you, each year for last 15 years for BSE and NSE both, whenever they put in money into settlement guarantee fund, income tax assessment officer will certainly raise a query, and it will go on to appeal for next 10 years and things like that. So, but still I have to do it because the sanctity of my market is of utmost importance not only to me, but to the country, right? And otherwise what you have is what we call domino risk. That one failing, one broker failing, and which will have cascading effect on 1,000 of them, entire country will fail. That's what happened in global financial crisis, because they were doing things on OTC basis, over the counter, while as what we do is centralized risk.
When you had this, I mean, I was there when this market didn't start, but do you see the regulator playing a very active role helping you in times of crisis?
I think.
Or they just beat you up just to tell the market that
No,
they're
broadly,
taking care.
see, they also have to play to gallery. I don't blame them, right? So they have to find some whipping boy, what they call Pinocchio or somebody, right? Or in American system, it's a big boy-looking stuff. You beat it up and some chocolates come out. By beating me up, nothing comes out. But at least they can feel that. So
They've shown the public that they've taken you to task.
they have taken to the task and they have thrown out the guy or put some 5 investigation on the guy. But boss, he's as helpless as anyone else. Right?
Oh, yeah.
Because
It's happened. It's not under control. It's happened.
See, when you give a loan in a bank, it takes 10, 15 years to default. At least the guy will also, if smart, he will default after a long time. In my case, I'm sitting here talking to you and suddenly things will go wrong. I will certainly not only lose my job, but I will have 15 investigations from CBI, ED, these, that, as if I was doing something here. And Mr. Damodaran, at least has been SEBI chairman, he can sort of vouch for me that I was with him. Otherwise, right?
You're on screen.
Shobhana, Shobhana, tell me, how do you look at the external risk environment? Now, you've got a president in the United States who's saying that they're going to look at healthcare and for drug companies, beat them up, reduce the price, blah, blah, blah. Okay? Then you got, I'm just asking you to think about it. You got third-party liability and people who do class action suits against you, right? And then you got technology moving forward at a rapid pace. AI is going forward. I think you're in the heart of technology, right? Now, the external environment moving against you, there is a political, geopolitical risk. The second is the risk of, let us say, innovation too coming and AI. How do you see the risk as an entrepreneur, and how do you educate your board? I presume that your board too has to understand all that, and you understand it probably better because you face it every single day, and you said you're paranoid, which is good. So how do you handle this? How do you see the future? How do you look at trends, the pace of change, and then make sure that you set up proper processes, including the committee, educate them to make sure things work?
I think that it's not just my industry, because health is very localized, and the possibility of, for us it was a bigger issue when the government announced that GST on medicines was going from 12% to 5%, and they gave us only 2 weeks to correct it. So we had to really get our systems, the strive, fail for, we do 1 million transactions a day, and even one customer that feels cheated will create problems. So for us, that was our risk. But if you look at it, there are companies that, overnight, with these, as part of CII, I was really in the thick of that, when the tariffs were announced. And the first tariff, and everybody said, at that 30% and 33%, and then India, acted full of bravado, it's not going to really affect us, we'll figure it out and all that. And then suddenly 100% came. And then as you went in, you saw what was happening in the country, and you knew that it's going to bring down GDP. So this is a risk. And I don't think that any independent director was knew, that they were studying it, because it's part of their, and we got a lot of insight from our independence that, that's the important thing. Get a variety of people. So we have bankers, we have ex-bankers, we have people from marketing, we have doctors, we have people who were big in infrastructure. So I think this variety is important. And of course, nowadays, legal with this thing. Legal departments, when you talk about class action suits, it's happening. Lots are happening in consumer. At any given time, people want to just say that, I'm going to put it, you didn't give me this, or you used 10 more gloves on me than you should. And these are all things that people can now just go to court and start litigating. So I think this justice system, of course, is overloaded, and there will be more and more of these class action suits, because they don't think that the pricing, so it really comes from pricing and what you get and your expectations. So our board is aware of that, And it's kind of risky for them also to be board members. Nowadays, independence, it's not that easy when, you're going to sit there and not just get
So
beat
you in
up.
the risk management committee of the board carry great risk being on the board.
Yeah, 100%. That's a risk there because you really don't want to be an independent director because you don't know which industry that you could be part of that will get hit by something, a class action suit. And in healthcare, you can just be walking and say, oh, you're a director of you didn't treat me well with this. So, I think I don't want to be frivolous about this, but I do think that independent directors today, or just every director, they spend a lot of time understanding the business. They spend a lot of time on the risk because they're personally involved in it and they're personally liable. So it's, getting that kind of people to come to your board and be part of it. I think that at larger corporations, it's not an easy find. So we can just say that are you guys, great board members, or are you this thing? But it's difficult for them also. So many people have asked me to be an independent director. I did it maybe one term, but I just could not continue with that because it just takes a lot of your time, it takes a lot of responsibility. So you step off. And I think that's why Mr. Damodaran has a forum like this, because if we're going to continue to grow as a country, we need a better quality and we need to keep getting these directors. So pushing back on you all that you have to give us, we're always looking for great independents to come in, as part of our board meetings, when directors are retiring or we're starting these other companies, we spend so much time trying to figure out who will join our boards. Because a lot of them that you want, are overboarded. And that's another big thing in India. So I might have gone off point, but I'm telling you one of my pains of being part of this business and why such forums are really important, because it's not easy. The biggest risk comes to an independent director. What are you getting? Sitting fees, some amount of this thing, but the burden of risk also sits mostly on an independent. You said it, no? You said because who was the whipping boy with that? They'll ask the independent first.
Shobhana, when SEBI did not renew my membership of NSE board, I was extremely happy.
So I can vouch for this.
Yeah, I said I'm so happy.
At least,
I don't have to say no. They felt in the wisdom this guy is not fit and proper, whatever it is. I'm so happy. Thank you very much.
I'll tell you what happened is, at least independent directors have ability to resign.
You can't resign.
So what happens is...
Huge reputational risk for companies.
No, reputation risk is fine. People like us who are sitting there, we are hugely vulnerable. We have no upside. But we have come in complete downside. So I'll tell you a story where, since Mr. Ajay said is sitting here, what happened is, NSE had a 4-hour breakdown in February 21. A new regulation came by SEBI, because after every event, SEBI has to come out with the regulation. Right? So they came out with a regulation that in case now onwards, any MII, which is market infrastructure institution like clearing corporation, exchanges or depositories, they fail for a particular length of time, which is 45 minutes plus 30 minutes, 1 hour, 15 minutes.
Yeah.
Then the CEO's salary will be cut by 10% and given to SEBI as a fine.
Yeah. Yeah.
And the exchange or whatever MII, their last 3 years average profit will be given to SEBI as a fine. Okay, it was a beautiful regulation from SEBI's side, because then now onwards, because you create regulations, there will be no breakdowns in exchanges. Once you create regulations, it always gets taken care, right? So that is how it happened. Now, when I joined NSE, that was in some ways retrospect a mistake, right?
Yeah.
Because now when I came back, I had a problem because of the Colo scandal. Because of, there are only 2 CEOs.
Unsettled.
There are 2 CEOs who had gone to jail. My wife was, even now she says, ki boss, ye naukri mat karo, right? But that is a household risk, but.
That's a good one.
Bigger risk.
But basically nobody was willing to join the organization.
Yeah.
I hired a secretary. He agreed. After 2 months, he was supposed to join by resigning. He said, no, I cannot join you because your organization has too many people going to jail. Now, and this 10% the existing ones were trying to run away as soon as they get a chance. But good thing was all the top management had many cases by SEBI, so that they will not be hireable outside. That's how they stayed.
So they have to stay to protect themselves.
No, just because nobody will hire.
Nobody will hire them.
Right. So I kept on telling, because there was no hearing there in SEBI. So whenever I went to Delhi, I would have only one request to him, ki, sir,
Please have a hearing.
please at least employees ko chodo, because how
for your
will
neck.
organization like NSC or BSC or NSDL will
Attract
work if we can't attract talent and who are always fearful, and then you will get only bad people who can manage the system, not the people who are actually capable of running those systems. So when you put too much of onus on individuals and go after them incessantly, because you have to prove to the world that somehow you are acting.
I want to ask Ajay Seth that
that's
question.
So
I want to ask him the question later.
to credit to him, because he's sitting here.
No, he was in government and is now
So
regulated.
he got it done.
He called-
At
he
least
told
the
you.
employee part was removed. Exchange part is still there. And then naturally many other exchanges went down. NSE did not go down, but
not
nobody
go
has find yet. That's a good thing or bad thing, I don't know.
Good thing. No, but tell me before we go to the
Although regulation
audience,
remains.
before we go to the audience, one quick question. How do you see the risk of AI, rapid pace of technology change, quantum computing coming, and all this allowing criminal networks to possibly hack into systems at a pace not seen before, because they got this power of computing and they got AI on the side and they can hide the best brains, paying them whatever they want to hack into a network. How do you see all the risk unfolding, and what do you think should be done by enterprises like you?
See, technology risk is the largest risk in today's world.
Today.
And not information technology. Technology
anything.
means anything that has not been done before, or anything which you can do sort of differently. Both for me are technology, right? Your businesses will change, but it can also stop because of somebody happening. Like on Operation Sindoor, first day, usually I get around 18-20 crore attacks to close down my websites in a day. 24 hours. I mean, I am the most attacked entity in India today. So 18-20 crore attacks is fine, because we do this every day, right? But on Operation Sindoor day, in 20 minutes, I got 40 crore attacks.
40 crores, sir.
Right? And so, basically, we have to be prepared for peak kind of situations. And so, those are the kind of things we work on, and still you can go bad, I mean, ultimately. And for me, the AI, I mean, when NSE started, it was a floorless exchange, right? People said from all exchanges across the world, NSE was the first successful screen-based automated exchange in the world. After that, New York, NASDAQ, everything became automated. NASDAQ used to be screen-based, you had to call to trade. NSE was like matching on the screen. Nobody was there, actually. But people used to tell me that once you bring it in, you will have all sorts of mafias coming, these, that. You have to keep on, see, those guys are going to use the technology the maximum. Right? And today also. I mean, today there are people, you can just pay them in dark web, and they will attack as many times as you want. Like you pay per attack and some very small amounts, robots are available, they just go haywire. But even otherwise, the amount of nonsense that can happen, but again, technology cannot be stalled, right? So the AI has built on the IT, right? If IT was not there, AI would not have come. But AI, the way I look at it is, the world is now at risk because almost 40-50% of America's market capitalization is on AI. That if somehow we capture the AI technology, then we can rule the entire world like what we did for IT and stuff like that. So they ended up saying that, and they created hype, shock and awe, saying if you have $500 billion, then only you can come to the table, otherwise you are a loser. Now it has become $1 trillion, right, in last 2 days. So they created a shock and awe, and also psyching up all other economy. Today morning, I was on panel, by the time I discussed AI, it was already over. But basically, it was said that India is the loser because Taiwan and China are winners, America is winners. And I have been saying that AI is just a tool. Crooks can of course use it, but good people can also use it. AI, I mean IT, India did not invent electronic chips. India did not invent Unix, Python, COBOL, Pascal, nothing, SQL, nothing we invented. Still we are the biggest users. And America was trying to say that we are going to capture this market because we have these fundamental models. We have like 10 people who are each $5 trillion. So that's where get impressed and don't come this side. China pricked the bubble by saying, what you are saying, $1 trillion,
Give it free.
I do it in $1,000.
Yeah, get it free.
So instead of making claims, China actually proved it by putting those sort of fundamental models on open source basis. Now that bubble has been pricked. Last 2 days, almost $2.5 trillion have been cut off from the AI companies. The top 7 in America are all AI companies, all IT companies. $2.5 trillion, half of India's market cap has just gone down in America without anyone knowing, because it has become a large risk. And and I have always been saying that users, when it becomes lower cost, users will use it the most. And that's where India's GCC, India's ecosystem of adapting to the technology. The societies which progress are the societies that don't invent. If they can invent, it's good. But how they adapt. India adapted to IT like fish to the water. We did not even telephone lines when NSE started. So I had to design a satellite telecom network as a mechanical engineer, which I did. It worked. It's a miracle how books sometimes are true. When I read the books, designed, and it worked. But broadly speaking, India took off 30 years. India changed itself. India changed the world, right? And next 30 years, because we have young people, demography is young, society is IT savvy compared to any other country in the world. It's going to adapt to the lower cost part of AI, which is now, like today morning, I was watching some Maya.ai. It has created some voice-related AI using some free credit available by Google in seeding in India. My son himself has a vibe coding stuff in India. But broadly, I see the users of India are going to use it much more effectively in GCCs, in
already being done.
Sort of development and stuff like that. So don't get impressed by what the psyching of population by American guys do it by saying trillion, trillion. And similarly, China also now it has come out in the open. You can also download, make your own changes and do it, right? So there is nothing there. Don't unnecessarily fear about AI and all. But if you don't use, you will remain behind, right?
That's the problem.
No, I'll just, Ajay, if I can ask you a question. As a senior government official, you have seen this whole risk issue from Delhi because you manage the country. I mean, you understand financial risk in the finance ministry. Now you are a regulator. What is your approach? What was your approach as a government official, senior government official, to risk in regulated entities and risk? I mean, a short answer. And as a regulator now, in a business which is all about risk management, insurance, how do you see the role of risk management?
By a difficult question, and I was not prepared for it, but
yes.
What the panelists said, known knowns, known unknowns, these are the ones which are controllable.
Yes.
We have to build enough
resilience
there, and what Ashish has been doing in an NAC, and that kind of a resilience. Unknown unknowns.
Yes.
There is something, whether in the government or you ask the question in the risk management committees, they are the ones who have to do that blue sky thinking, where is the next unknown is going to come, how prepared we are. And of course, it's not saying that we can just keep on investing money, because then the capital has its own cost. So at the policy level, these are the issues, that what kind of a resilience we bring in. But important aspect also is that what is the downside, what Ashish brought in. What if a particular organization or system is down for 10 minutes, 15 minutes, 20 minutes? Have we built a system that automatically trade will shift to another exchange? Okay, there's a kind of a resilience is there. So that kind of a maturity in decision making at all levels, even the regulator, things will go wrong. Things is not a copy.
And you accept that?
Huh?
You will accept that?
We'll accept that. That is a kind of a sagacity or simple wisdom, common sense. That is what we have to bring into the table, and that's where the work should
And make sure it doesn't happen again.
That doesn't happen, of course, that doesn't happen again. And NSE is a clear example that where it will move in, and that kind of a lessons which they have learned to improve their systems again and again.
Good. Okay, folks, questions from the floor. Yes, sir.
working. Okay, I will. This
Yeah.
thing. I was a sergeant in the NCC. Namaste, this is Surya Narayanan. And coming to the topic, that is risk management committees, have they come of age? I have something much more basic to any of the panelists. Risk management committees, do they come into existence in companies only when there is a regulatory prescription? I mean, this has been my experience. And I will take the liberty of the second question. Do you think risk management committees should be totally de-linked from the audit committees, superintendents, because the skill sets required are totally different? I mean, with due respect to audit committees, they don't understand risk as much as specialized risk specialists.
That is a very strong statement. Anyway, Shabana?
One is that opening I said that you can't aspire to be the next 1,000 by not understanding risk earlier. So we do have to design. The thing about the audit committee, I agree with you, they have their own set of, they have their own agenda and how they have to drive it. And risk is something that if you don't devote the attention to. But now we're seeing also a lot of cross-references when it comes to, you do need some of those members, you do need some of that eye also into it, because a risk committee is only as good as it's integrated into, we talk about medical, for us, we have different committees in this thing, but are they part of strategy? Yes. And audit is one of the tick boxes. It's not, when you combine both, I think you're not taking risks seriously. That's the bigger question. That's the bigger answer to me.
Yeah, go ahead.
I'm just thinking 6 years ago on this day, I was running a company with $1 million of cash every day. And I'm sure a lot of people in the room were also running companies. Nobody saw COVID coming with all these high-priced risk consultants. What is the risk of the next pandemic happening in the next 24 months? Anyone?
No, Shabana.
About 24 months, that's a long time today. So it could very well happen. But I think what's happened is that there's more preparedness. Because when we talk about risk, remember how we were saying, have we learned from it? Have we this thing? So I don't think in the next pandemic that we'll run out of oxygen, that we'll run out of supplies, that there will be capacity available and how to open it, operating procedures, ability for the world to talk to each other. And I think the openness that is now available. So yes, we have to understand that all these things can happen, just as they will in terms of cybersecurity or something in AI, bringing things down. So everyone is prepared for the next pandemic.
Vaidya, let me ask you a question too, because it's important to have wisdom. Now, do you think India has enough professional risk management expertise in risk managers from the enterprise side and from the board side? People who can sit and possibly look at risk management, sit on risk management committees of enterprises. On both sides, do you think we have enough capacity and knowledge built in, or is just a progress? We have to progress more.
My own sense is that these days the extent of usage of AI/ML models in India in running risk management systems have far evolved more, by the way, than even some of the other developed countries that I come across.
You're saying that?
Yeah. So when you go and see some of, some of these countries and say, I actually met one of the developed country, one in Europe and one in US also, and mid-sized bank in the US, which is much larger than Indian banks. And I was a little disappointed to see the level of technology they had in evolving and computing risk and estimating risk and so on. At least the models were not as evolved. But one area where I feel India is not as good which I feel could do better is cyber. Because I see Israeli companies really beyond your imagination cutting edge. So I would differentiate risk from cyber to regular risk management.
And in terms of risk managers, specialists in risk management, and people who can sit on boards and understand risk management to help enterprises, do you think we have enough capacity?
Well, I mean, it depends on respective organizations, their ability to attract talent. For the reasons, Ashish and Shobna, etc. talked about, with the level of awareness about the risk which board members themselves go through by being on certain committees. I have spoken at least maybe 20 or 30. Yesterday evening, I spoke to some people at the dinner. Some of them were asking me whether there's an opportunity to come onto some boards. But the first thing they told me was that, look, I want to be in good company, and I don't want to be in any trouble. So this is definitely on people's minds. I'd say that it's more the willingness to join with the level of 2000s, 2010 to 20. We just saw so many names in India. Corporate governance went bad. I think the last 5-6 years is better. But after those experiences, people are quite cautious these days about joining any boards.
Okay, let me ask a lady, then I'll come to you. Any lady, any woman here asking a question, please? Yes, madam.
So, Ashish mentioned about the issues that they faced. I generalize that for the services industry now. And I say that what I have noticed during many years of observations is that there is a lot of focus on people who bring business, so client-facing work and stuff like that. And the people who actually manage your systems on the backbone and all that are many a times ignored in terms of the voice within the organization, or simple things like we need so much capital expenditure, for example, for upgrades. So I have noticed that at least in service industry, these things are a major risk from the angle of the way it is viewed by the management.
Are we investing enough in risk management?
Are we investing enough in people who understand risk management?
People, okay. Ashish?
I mean, I agree with her. She has been part of stock market since I have been, and so we chat up once in a while. But broadly, risk is a very interesting concept. Like Vaidi talked about models having risk management. For me, there is a concept risk on model risk, that models themselves are wrong, right? And so everything will have a secondary, tertiary situations, and you need to have basically risk management degrees, because the amount of risk that is going on, of course, the actuarial people in insurance, they do, but they are into more financial part. But the rest of the gamut of the risks which now the modern large organizations, even smallest organizations have to face are immense, and they're changing so rapidly that we must have some sort of a formal sort of a framework.
Training system and education system.
It's a fundamental thing is, I don't even think we invest in it. It's just like India doesn't invest enough in research, but we still expect to get that kind of, to be a China or a US. With this, we'll get there, but, it's the same thing with risk. What are we actually investing? Yeah, we hire consultants and we do this thing, but are we investing in our board members understanding what it is?
Let me provoke you again. Do you think boards themselves are a big risk for enterprise? Because you may not be able to get the right kind of people in the board, people willing to join the boards and all that. Do you think that's the risk that you see as a founder of enterprise?
No. I think that the risk of not having a board is much worse.
Much worse.
So flying solo.
So getting somebody is less risky than not having a board at all.
Yeah.
Ashish?
No, I fully agree. Ultimately, you can't eliminate everything, right? And so you will have to live with what is reasonable, and still you will not be able to touch many of the risks which may be obvious and apparent, but ultimately...
Okay. Sir, question for you. You wanted.
Nasir.
No, I just want to put something on the table. I've sat on enough boards. And on risk, a lot of companies have worked the system. They're ticking the boxes, doing all the risk registers, everything happening. But I differentiate between endogenous risk and exogenous risk.
Yeah.
The endogenous risk is now taken care of.
We have grown up enough.
We've grown up. Exogenous risk, we have no clue.
No clue, or we're just growing?
We are growing, but it's very, very big. You see, if you ask any company today, how much can you predict the future in terms of your market, in terms of the business, in terms of geopolitics, in terms of other sort of risks that might hit you? The internal capabilities of a company doesn't exist. You don't have to be a searchlight today. You have to scan the environment, look at the environment, internalize the environment to the extent that you require it in a company, and get on with it. Tom Peters once said, the future has already happened.
Yeah.
Right? Which means that you have to read the tea leaves. It's already on the ground. How many companies today can read the tea leaves? Do they have the capacity to read the tea leaves? Do they have the expertise? In fact, we have to now generate this. It's not just the board, and board members ought to do that. I'm doing that.
As an ecosystem.
An ecosystem that's also within the company. So I think this is a whole new area that needs to be developed.
Now, let me end this because the time is up. I can only conclude to say, from the discussions, everybody understands that risk management and business is all about managing risk, earning returns on a risk-adjusted basis, having a risk management committee to the board, which was mandated, now has matured. There's an important thing to have a risk management committee. It does reduce risk. Enterprises are building up capacity within, and they're seeing an increase in capacity. They're understanding the risk. The unknown will remain a problem for us, including government, regulators, etc. And we have to build a next level of capacity on understanding about what the future unfolds in the ecosystem, and build ecosystem players, understand that to the greatest extent possible, assimilate that and do it. But we have come a long way in the past. We still have a long way to go. Thank you very much. And Shobhana, thank you, Shobhana, and thank you, Ashish, and thank you, everybody, for being a good audience.
May we request you to please be on the stage. So I'd like to take a moment to thank Mr. Ashish Kumar Chauhan, Dr. Kamineni, and Mr. Pai for providing very useful insights in this panel discussion. May I now request Mr. Damodaran to present a memento to each panelist. Ladies and gentlemen, can we once again welcome him on stage with a round of applause? On behalf of each panelist, Excellence Enablers is proud to have sponsored education for one girl child for 1 full year through the NGO Nanhi Kali, a Mahindra initiative. Thank you, Mr. Damodaran, for doing the honors. Once again, thank you to all the speakers. Ladies and gentlemen, can we once again give them a big hand? So with this, we come to our final session, which is the growth governance equation. Has a balance been struck? Some persons, mercifully decreasing in numbers, believe that growth and governance are not naturally aligned. Is good leadership the glue that keeps them together? Please welcome our panelists for the next session. Mr. Nasser Munji served with HDFC for over 20 years at various positions, including as its executive director. Mr. Nasser Munji was the managing director of Infrastructure Development Finance Company Limited, IDFC, up to March 2004. He was the chairman of DCB Bank Limited from June 2005 to August 2021 and continues as a board member. He is on the boards of various multinational companies and trusts, including being the chairman of Aga Khan Development Network, AKDN. He has been a technical advisor on the World Bank's Public-Private Partnership, Infrastructure and Advisory Fund. Ladies and gentlemen, Mr. Munji. Our next panelist is Mr. V. Vaidyanathan. He is the Managing Director and CEO of IDFC First Bank, formed after the merger of IDFC Bank and Capital First. After a decade-long stint at ICICI, he acquired a stake in an existing listed non-bank financial institution and guided it through a transformation into Capital First, ultimately merging it with the IDFC Bank to form IDFC First Bank in 2008. Prior to assuming this current role, he held the position of Chief Executive Officer at ICICI Prudential Life Insurance and was a member of Board of Governors at ICICI Bank since 2006. Before joining ICICI Bank, he worked with Citibank for close to a decade. Ladies and gentlemen, Mr. Vaidyanathan. One of the panelists who is also the moderator for the session is Mr. M. Damodaran. Over to you, sir.
Great privilege sitting alongside both of you to discuss with the growth and governance. So I said it's a great privilege being with both of you to discuss whether growth and governance are facing in the same direction. Are these opposed to each other? Are they traveling in the same direction? Is governance likely to propel growth? Is growth likely to, shall we say, make governance more relevant? And how interconnected are these? So I was reminded of a statement that a former governor of the Reserve Bank made. When somebody told him, you have to address both inflation and growth, he said it's like riding two horses at the same time when the two horses are facing in the opposite direction. So how do you ride those two horses? The challenge is not as big here, but if you look at the history of corporate governance, in the initial years, there were atheists who dismissed governance as being of any consequence. Then we saw agnostics who said, let it exist. We are not quarreling with that, but we will not give too much importance to it. Then came the believers who believed that if you have good governance, it's a necessary condition, but not a sufficient condition for growing a company. You need several other things alongside good governance, which is where we are now. Because in the initial years, even very learned professors asked this question, where is the evidence to show that well-governed companies produce better results and do better for the stakeholders? Now I think we have enough evidence within India, outside of India, to show that governance is important. So my first question, and I'll start with Nasir, is the way you have looked at the companies that you've been associated with, the groups that you've been associated with, do you see a causal relationship? I know that they're both good things. You need growth, you need governance. Is there a direct causal relationship between growth and governance?
I think, first of all, thank you very much for inviting me here, and it's been lovely to be with you. I've been, for 20 years now, since IDFC, on corporate boards. So I think I've sat on 30 corporate boards, Indian corporate boards in these 30 years. So I've seen an evolution. In the early days, governance, as you quite rightly said, was very limited. Sustainability was not even in the picture. And this idea that the businesses have a responsibility to the environments around them, the triple line bottom reporting, GRI, all of that, nothing was there. So in a sense, the whole culture has changed. And today, and when you say governance is important for growth, it's because the world has realized that there's a different dimension of a company. My old professor, Milton Friedman, always said, the business of business is business. Don't get into all this social stuff and etc. You have to serve your stakeholders, your investors. Don't worry about anything else. Just make your profits and that's it. Those days are gone.
Mercifully, we have moved from shareholders to stakeholders.
Yeah. Shareholders to stakeholders. Stakeholders, a whole range of things. But even today, if you look at it, wage labor in the West, you look at Amazon, do they pay their warehouse employees? How do they do it? What is happening? So in a sense, that stakeholder relationship is also very capitalist at the moment. It's skewed towards capital rather than labor. But all of this is happening, at least as a recognition that is happening. Personally, I think this causal relationship is now changing very dramatically over this, and especially in the last 5-7 years. And I think with LODR, I was very against CSR, for example, the same idea that you force companies to invest. But today, seeing CSR, I'm all in favor of it. I think it's just amazing what it's done. About $4 billion has gone into CSR funding in India. But more than that, it has made individuals and companies, both management and workers and people, engaged in something around in the societies, because they volunteer, they work. It creates a sensitivity. And I think this whole combination has changed the whole ethos of a corporate. It's changed completely in the last 5-7 years. So I think today there is a very strong causal impact of the governance on companies and companies on governance. I think it's going both ways. Companies are also demanding better governance internally, which wasn't the case in the past. The issue now is finding the right people, the right skills. We've talked about that earlier. These are the early days, I think, still. But there's always a dilemma between growth and governance. There always will be. And unless we manage that, maybe we'll get into that a little later, but managing the dilemma between growth and governance is going to be, I think, a very crucial play in the next few years.
Vaidi, what's your take on this?
Thank you. First of all, thank you for organizing this, Mr. Damodaran, and great to meet you, Nasir. My quick comment is as follows. The fact that, in 2010, I left ICICI. So I was already in the board of ICICI, running a large bank, a large part of the bank. And I stepped out to start this NBFC. I'm just telling you why there's a strong causal relationship. I'm just telling you. And I've experienced it firsthand. So we had a small company. Small company means like small, like 94 crores of loan book of retail and 1,000 crores of loan book. In financial services, it's quite small, let me tell you. So small NBFC, ridden with legal issues, a lot of bad loans, hardly any employees. And I was trying to acquire that company thinking that I'll go to RBI and try to convert it to a bank. But with all those problems, I tried going to many private equity firms to get equity capital to back it so that I can make some size scale out of it and go to RBI. So the point I would say is that with all the troubles that was there in the company, I used to tell people that, listen, this is business. We may get it wrong, a little bit temporarily, but I will never, ever let you down on governance. And this was my pitch because I didn't have any number. Everything was spreadsheet, right? And spreadsheet, who can fund spreadsheets beyond a point? So I used to tell people that India's opportunity is great. We can build a good business, but I can never go wrong on governance. And, Deepak Parekh actually supported me when one of the funds went and asked him for a reference about me. They told him, look, he's a good guy. But one thing I can tell you, that if you've got to back anyone in the country, back him. Now, Deepak Parekh saying that about me when I was only 42 at that time, it actually was a big thing for me. So my take is that, and then of course, then IDFC happened, and IDFC again released lots of capital. So my experience in life is that whether we have a product ready now or not, but on the strength of image, a reputation, a feeling and a belief that the governance won't go wrong is a very big causal effect.
Are we seeing some kind of a reversal, especially if you look at the US? People, companies, and we heard this mentioned earlier, are scrambling to take DEI off their policies. They don't want any talk about inclusion or diversity. Advisory firms in the US have taken that away as one of the determinants of a business being run well. And a distinguished professor last year, sometime last year, somebody who is respected, with whom I share a name, but then that's all that I share with him. He said that ESG is a feel-good scam. You feel nice, but as far as the company and its stakeholders are concerned, it's a scam. It doesn't add any value. Now, are we seeing some kind of regression, or are we likely to remain on this path where we tell ourselves, yes, governance is a great thing, we need governance, we need several other things to push companies forward too? Are we understanding this concept of governance clearly? Because half the people think governance means ticking a few boxes that the regulator or the lawmaker wanted you to do. Are we moving in the right direction? Have we come to a pause? Are we regressing?
No, I think we are moving in the right direction. I think the US is deconstructing. It's deconstructing right through. I mean, if the president of the US can say, drill, baby, drill, for God's sake, you are in a no man's land, you know. And this whole thing about immigration, the way they're treating immigrants, the way they are dealing with labor and the unions, the way they're treating, this whole issue of what do you call it? DEI. Is a regression. And I think it's not something that one would want to replicate. I think the more enlightened part of the globe will not move down that direction. It'll be moving towards the direction in which we have been. So I'm very much, and this idea that ESG is a scam is nonsense. Because today, you cannot have business as usual as you did it 20 years ago and survive as a civilization on this planet. It's not possible. Business as usual is not an option. So we have to now progress, and I think ESG is a way of progressing in a profitable new business model. ESG is not something icing on the cake. It should be defined as actually creating a different business model which is much more efficient than the past. But if you just do this as a do-good thing, it's not going to work. But as a business model, if you do renewable energy, you can see your power costs come down. If you do recycling, it benefits not only society, but you. So you can see this happening. Now, for Indian hotels that I'm on the board of, we're doing this in a huge way, and the impacts are being felt. Not only are you doing something good, but the costs are being addressed. So you actually redefine the business model, and this is the way to go in a more humane and in an integrated way, where companies are part and parcel of society at large. They are not just profit-making entities exploiting the environment, not counting the costs of the externalities they impose on the economy. That's not possible. That's over. And anybody who says that that's the way to go is in cloud cuckoo land, So I think the US, unfortunately, is down that road, and it's not a model that we should even think about following.
Vaidhi, is there something called a governance premium? Is it a myth? If you look at it from the average investor's point of view, is he or she actually factoring in governance premium when looking at companies? What's your experience?
Very clearly, you've been at the forefront of governance, so you know this really very well. The thing is that, at least, I can only talk by experience and not academically. I have experienced this governance premium all the time. For example, when our previous company return on equity was 8%, price to book was 4%. Today our bank is running, let me say, 4 or 5% return on equity, which we all agree in the banking system, I understand, quite low. Reality should be like 15, 16. But, and it's quite hard to raise equity, quite hard, right? And we have raised 6 rounds of equity at an average of 1.6 times price to book. We have raised 21,000 crores of equity on a starting equity base of 15,000 crores. That too, when we're posting losses, when we are posting, writing off bad loans and all that, and we are still bringing up the company, return equity is low, everything. So, I mean, what explains it? Normally, something like this could be, So, I do believe, people believe it. Just now, last month, we raised 7,500 crores of equity from 2 large institutions. I believe there is a definitely premium, and more than that, availability. Yeah. One large institution, a few years ago, which went into moratorium, etc., they just ran out of equity. They were not getting it in due course in time. So I think the availability is a very big deal. Price of availability is better, and there is certainly a premium. You can see that. I mean, I'm experiencing it.
You are seeing evidence of governance premium in our markets.
I told you, I've raised 6 rounds of equity at a price to book of 1:6. When the price, when return on equity is 4 or 5, it doesn't happen. At least we are benefiting, and of course we are seeing it all around us, right? For the same earnings, somebody's trading at half the price of the other. There is a value, and I think when but by itself. It is one component, but when coupled with, let me say, good conduct, good governance, let me say, good return on equity, good economic indicators, good growth, good moat, the combo becomes very powerful. But governance is like it's like essential.
Yeah.
In fact, I'd say that growth doesn't conflict with governance. Probably governance is enabling growth, is the way I think about it.
No, there was a time when people thought that economics and ethics couldn't coexist. Yeah. Luckily, we've moved beyond that.
Yeah.
If we come to a stage when we recognize that governance is an important consideration. But if you actually look at the way companies address this whole concept, is this a boardroom concern, or does it percolate down the organization?
Sorry, what is?
Governance.
Governance. No, I think governance is now, at least it depends on the group. Now, for example, the Tata Group, the governance is always a major issue. It's always addressed that there's a Tata Code of Conduct, there's a Tata way of doing things. So it helps the companies in the group. But if you're not in a big group like that, each company is now aware of the importance of governance, good governance, and looking for good people to be on their boards. That's very important, because when you look at governance, an investor will say, who's on your board?
What are good people to us? Yeah. Because we heard in the previous session, are good people the guys who don't ask questions?
No.
Yeah. Okay.
Well, obviously, good people are the ones that investors would respect to have on your board. So that means people who will ask questions, who have a record of independence. And they have the requisite experience and skills. I think the market addresses that, asks those questions. So the board, even if you're an NGO today, the board is very important for the donors. It's always on governance. It's who's there, and how are you running the show is very critical. Now, for the Arkhan Royal Support Program, which I'm chairman, and we have a superb board, we recently got a $7 million untied grant from Bill Gates' wife's firm, So, you don't get this sort of thing when recognition, what is the recognition? It's the people and the work that you're doing. So again, that's what I mean by people who demand, good guys, who demand, who have the respect, of the communities in which you serve. So I think, but then the trouble is also there are a limited number of people who are ready to join boards today. It's very difficult now. If you ask people, you have a board vacancy, it's not easy. There are a lot of people who say, I'm not going to join a board.
No, the good guys are saying no.
The good guys are saying
no. But there are guys who are dying to get onto boards.
The good guys, I'm saying, good guys are saying no, because they know what the response is. They say, we don't want to do this. Try and get a chairman of an audit committee today. It's not easy. It's not easy. Especially a bank audit committee, it's a nightmare. So sometimes we should ask the question to SEBI, is that, today, good board members will join the board of maybe the top 50 companies to which they subscribe to the values and the approach. What about the 5,000 odd listed companies? How are they going to find their boards?
2,500 should never have been listed out of those.
All right, so cut out those 2,500.
Yeah.
So if it's 2,000 companies, you'd want some of us to actually join those boards. If I was a regulator, I'd say, I'd like the top members of people who've got this, I'd like you to join the boards of smaller companies because you could help them develop, because you want good governance to spread. Are we helping good governance to spread? Answer, no. Because we are actually limiting the number of people who will even join good boards.
Yes.
So how does that help in terms of governance?
But end of the day, everybody has got to look only the well-known and the available and the high-quality people, etc. How does the country develop 5,000 companies? Yeah. Every company used to have 7, 8. You need 5,000 into 5. You need 25,000 members of the board who we want to be good, etc. So end of the day, we've got to develop a way of bringing in good board members and making them good board members through awareness, through responsibilities, and so on avoiding conflicts of interest and so on. Because, even to the previous point, if you notice, even Theranos, for example, or Enron, for example, is a Forbes, whatever they were, best governed company for 6 years in a row. And that was Enron.
Johnson & Johnson
was
rated very highly for governance till they had to pull back things from the market.
But still, at least they did a good job. They pulled back on Tylenol. They pulled back on Tylenol, at least they did. But if you see all of the names, like Wirecard, Satyam, if you see ILFS, if you see all these names, if you go and see their annual reports, they talk a lot about governance, but governance is not what they say, governance is what they do. And in fact, if you go and see Theranos, I was reading up the story, that they are saying we want to democratize, health reading across the world, and they were sitting and cooking books about the records, right? And they how it was, and so on. So therefore, it's definitely a lot more than what we say. It's what we do.
Yes.
And that is a very big thing. And therefore, how our employees experience us. How our, and that smell flies. You can't control 1,000 people talking about yourself. How customers experience us, how our informal ecosystem talking about us. And that, I believe, is a huge puller. Just now, in the last round of money we raised, the party the two parties were talking to us. They actually, for our bank, they went and studied about our bank without talking to us. They commissioned an independent study, talked to 1,000 customers of our bank and peer banks, and then came and evaluated us and said, okay, now we're good to invest in your bank. Now, how can I control how they talk about us? So therefore, it is far beyond what we say. It's about what we do and how people experience us.
I think it's interesting to make this point that it is not about what you say, but what you do. Enron's code of conduct was 64 pages. One of the best drafted codes of conduct. And I think almost every other provision in that was violated.
Yes, exactly.
In a matter of few months. So it's not the length of the code, the detail in the code, but I have a related question that how important is communication in promoting good governance? And are we communicating enough? Are we saying the right things to the right people? And not in complex sentences so that they don't understand.
See, it's one thing. Let me start with that. When we say communication, again, is about both internal and...
Not just Reg 30, because Reg 30 is very...
you know how that is.
Yeah.
So, even external communication, again, I can just say that our own employees often, because let me say now we are much stronger bank, so to say, but in the early stage, so we were posting loss after loss, and Nasir knows for 6 quarters in a row we were posting losses. So how do you deal with it? Either we say to our people, say to the market, this is the reason, this is the background, this is the future, believe in us, we're going to be good. or try to hide. And sooner or later, people figure out who's hiding, who's not. In fact, I have a practice that after every time results come out, good or bad, I actually call for a town hall. Town hall, like nowadays everything electronic. We call the whole bank on a call. Whole bank. We have 40,000 people on Teams call or any of the calls, and we just have a rapid 30-minute discussion. We shut it 30 minutes, but we do that discussion. So people spot it. And that communication, I feel, becomes important. And that's why I say conduct I'm experiencing is more important than, and communication I do feel is like super important.
Yeah, absolutely.
That's
we do that in
your
DCB.
point?
Yeah, in DCB Bank, we did the same thing. You know, we still do the same thing. And in the early days, when I took over DCB Bank, it was 1 month from closure. We were in such bad shape. And the Arkan himself asked me to take over the bank and do something with it. We were a 4,000 crore bank, absolutely in the pits. Wow. You know, so I said, I didn't want to do this job. I said, what am I going to do? I mean, there's nothing much I can do. So I took this bank by the scruff of the neck, and we started cleaning up. And again, on the basis of my name, and with Deepak Parikh's help also, we raised private equity, just on the fact that we were doing something different. Sacked the entire management team, built a new team, slowly built the new culture of the bank as we moved along. A totally open, free culture. I believe in ESOPs, we believe in ownership, and I believe in people working with their hearts and their minds. So everybody's part of it. You don't work for DCB, you are DCB. So each one is part of it. And me as chairman, is first name basis, always NASA, walked around with the people everywhere. I even do customer relations meet. Which chairman of which bank does customer relations meets? Yeah? Right through the country. So it is a different approach. Today we are a 100,000 crore bank, 90,000 crores really. So it's grown from nothing. Gradually, again, using banking 101, nothing fancy, but retail, fully retail. Again, that reputation, again, you talk about governance, it's good governance. Today, there's people waiting to take our equity. There's not an issue. Raising money is not going to be a problem. But the point is, how much do we want to raise and why? At what price? So, you know, in a sense, we are just growing at 20% a quarter, and that is, you know, just gradually. We don't shout from the rooftops, it just grows. And branches grow, the whole thing grows. So I think the answer here is nothing to do fancy, but to do things properly and with a culture. I'm a great believer in building culture within organizations. So DCB culture, my biggest regret was, when I was chairman, to lose my best people. And all the banks were chasing our chaps. You know, they wanted all our DCB. I said, if I lose one of the senior people, I'm really in trouble. And they were being called for interview, and I said, go and have an interview. So they come back and say, what? They're offering me twice the salary, join tomorrow. So I said, well, what's your choice? They said, we're not leaving. This is our bank. There I'll be doing a job. Here we are DCB. You know, it's that whole belonging and etc. So we have not had any attrition at the top right through. HDFC was the same. I built HDFC from scratch. Try and see whether there was attrition in HDFC. Never. Look at the senior people, all remained till the end. Why? Again, ownership culture, very strong. The unions tried to create a union. I was there, this Shiv Sena union and Datta Samant to come there, charter of demands. I said, say, all right, get 50 signatures before I even talk to you. They couldn't raise 50 signatures from HDFC employees. They said, we're not interested. So, you know, it's that culture that is important. It's building culture. I think in Tata's, again, there is a culture, but not all companies have this culture, even in the Tata group. But building culture comes from the top. It's how you really involve, and that's governance again. Culture is governance.
Culture is governance, yes.
Culture is governance. It's a hard thing to do, but it comes from the heart that you are all part of one enterprise, you're building it. I've just taken over as chairman of Arca Finance, which is a Kirloskop group. Again, we are building the company from scratch. I've taken the ex-TMF lot, which is the Samrat and all his group, because they were, TMF was merged into Tata Capital. So a lot of these guys said, we don't want to go into Tata Capital. They came to Arca Finance. So we are building this company again from grassroots, again from culture. Very strong culture. I've also taken over as chairman of MMTC PAMP. It's a Swiss gold refining company in Haryana. Again, it's completely changing that culture. When I joined it, it was all over the place. I spent a lot of time building culture. That is a chairman's role, is to build culture.
You did this in a Haryana company?
Yes.
Because Haryana, the one culture that grows the agriculture.
Exactly.
Yeah.
So, it's everybody, in silos and all of that, So when you talk about growth and governance, if you're in silos and you're not working together and you're not prepared for the growth that you're going to get, you have to prepare for growth. Now, Indian Hotels, for example, in 5 years, it's just grown enormously. 300
Are young
hotels.
people buying into this culture business?
Sorry?
Are young people buying into culture, or are they saying
Absolutely.
we have a transactional relationship with our employer?
Absolutely. I think they buy into the culture.
No, you're talking about your organization.
Yeah.
Generally, as you look around.
No, I'm saying generally speaking also. My general sense is that, in the younger generation these days, they're actually more conscious about some of these concepts. More, not less, right? Are we green?
Yes.
Right? Are we? If you actually find plastic lying around, wasting it, they'll feel it more than people in the 30s or 40s. I definitely feel that way.
No, absolutely.
Okay, let's throw this open to the audience. It's the last session, so we need more questions. Right, Suri, go ahead. Yeah. We have proved in the morning that you don't need a mic, but nevertheless, yes.
Yeah, this question is addressed to you, sir, Damodaran, sir. And since you have brought this topic into this thing, has a balance been struck? So do you believe that growth comes at the cost of governance, or governance is an impediment to growth? Otherwise, this topic would not have come.
Okay. Is governance an impediment to growth? It's not something that I believe in, but topics for discussion are not, manifestations of personal belief. They're issues that are generally being discussed by everybody. So my job is to bring those topics here so that we get a larger view. What is your view? Is governance an impediment?
According to me, no. I mean, I just give a simple example. Now you have this Vande Bharat introduced, high speed, 130, 140. So I don't think they introduce it on routes where the tracks cannot take that speed, or the signaling, or even good loco pilots are not available. So growth or higher speed happens only when there is governance. So I don't see that there is a conflict between the two.
Okay. Anyone else? Yes, at the back. Yeah, I've been a backbencher all my life.
But just as an
I will
aside,
encourage backbenchers.
you can have growth without governance.
Identify yourself and then ask your question.
Right? So it's not necessary, but it's good to have. You can have a lot of growth without governance.
Yeah, but one day it'll be like...
One day it will.
But one day it'll blow up, like, driving a car.
One of my things is, in India, we have these Businessman of the Year awards, ET and Business India and all of that. Where is the award for principle-centered leadership? To me, count the number of principle-centered leaders in India of companies.
Maybe there are, maybe we don't look for them, maybe we don't find them because we are so consumed by the lights flashing on those who are, shall we say, ex officio. Leadership can't be ex officio. You occupy a position, that doesn't make you a leader. You are in a leadership position.
You know what? When we talk of governance, we tend to think of governance conventionally. Think of like governance, like corporate governance. It like almost comes together. But actually, when we look at governance, at least my experience is that it's at all levels. If you're doing selling, are we doing mis-selling? That's part of governance. If you're doing marketing, are you spamming? Are you communicating, right, properly, right? That's part of governance. If you're doing technology, are we bringing adequate amount of security into customers' transactions and so on? That's part of governance. If you're doing HR, if you're doing are we being fair with our employees, communicating well, etc. We talked about, and so on. We discussed earlier about ESG. Now, we understand in our day-to-day life that, look, environment is playing a havoc. And last year itself, we saw floods here, there, it's affecting our businesses. So, are we enabling business in an environment-friendly way? Now, these are all, in my mind, governance. And we should tend to see them along with corporate governance, because otherwise we tend to see governments more in the head of corporate.
No, that is tick box. What you're talking about, normal.
Yes.
But it's really value systems that go much beyond what regulators prescribe.
At governance at an operating level is the point I'm making, is super important and as much as a corporate governance.
Let's hear the question from the lady. Yes, go ahead.
So I'm Brijbala Batwal from Mahindra Finance. Thank you for a very insightful session. My question is that how much premium do Indian markets or investors attach to well-governed and well-growing companies vis-a-vis companies which are merely chasing growth? And as in, are they priced fairly? And any illustrations will be great. Thank you.
You want to take that? Well, because I have a story to tell, but I'll tell the story last.
And maybe if you want to tell the story last. But you see, the thing about, oftentimes the market may mix up the two, right? For example, you may, like to your point, there could be a premium because of growth. There could be something premium because of governance. Now, the truth is that both of them give their own premium, so to say, and oftentimes the signals mixed with each other in the short run. But when you take a longish run, let me take a 5-year, 10-year, if I take a window, then definitely, governance, as we discussed earlier, has a premium, and it begins to show, one thing on this investors, since it's specific on investors, you'll be surprised. When investors are looking at organization to invest, and I'm as I told you, I gave one example, I don't mean only a private equity firm investing in you, even like FII is investing in you, even DI is investing in you. They are going around poking the system. They're coming and talking to some of branch managers and say, how's the bank running? They're going to the DSAs and partners and saying, how is the bank? They're going to technology providers, to IDFC, and saying, how is this bank? So on. So what I'm trying to say is that people are now doing references about a bank all around before taking market positions when they want to take a long-term position. And therefore, I am now beginning to become a believer that the truth cannot be masked, and we better be good at the core, and numbers and talking and advertising don't work.
Yeah, Rajit, go ahead.
Sorry, HDFC is a great example.
I'm Rajlakshmi Rao. I think India is all about soul. We all have a soul as a country. And any governance issue is all about how people have perceptions of that company. Whatever be your balance sheet, they may invest in your company, but at the end of it, through long term, as he said, people are watching. You can't just waylay that thinking. You have to have good governance. That's the only best way and a road to success. Of course, you have to run it well, but then people's perception is very, very important. The entire country will stand by that company. If some they're being wronged, the wrong reason by any regulator. But people are still with them because they know it's good governance. I think that is very important thing besides all your balance sheets.
Yeah.
Why do we look at regulatory validation to understand whether governance is good or bad?
Newspapers bring it to their notice.
Regulators are looking at compliance.
Yeah.
They talk in terms of governance, but their focus is compliance, which I call playing black pieces. You're not making the first moves. So when you play the white pieces, you make the first moves that you're practicing governance. So you got to go, not lean on regulators. I hear this very often. How will regulators ensure that independent directors act independently? You can't. You're not sitting in the boardroom figuring out what questions they're asking, are they opening their mouths, going back to the quality of directors. The one person who is a very sort of active in whatever he does, he didn't get any board positions because people said that, you know, he opens his mouth too much. And the poor fellow had to tell them that, look, I open my mouth to consume the tea and biscuits because I haven't learned how to do it without opening my mouth. Right? And you think I open my mouth and therefore I am a bad element in the boardroom. So I think we need to look at, get the right people, have the right value system and do that. Now, if you look at what happened in Satya, after Ramalinga Raju's famous letter of 2009 January, obviously his shares tanked. It had to tank. But there were questions in the market, didn't last too long, for less than 24 hours. Somebody said, PwC did the audit. Are all PwC auditees to be looked at a little more carefully with caution? Question one. Number two, it's an IT company, large IT company. Should we start looking at IT companies' numbers with some skepticism? Right? Number three, you are from Andhra, of course. I hope there aren't too many people. Raja is a friend. No matter what I say, she will not think badly of me. The third question was, is this a problem we have with entrepreneurs? You know entrepreneurs, of course. Yeah? There are lots of companies. Is this an entrepreneur problem? Yeah. The markets answered all these very effectively within 24 hours. None of those people who had this particular commonality with Satyam suffered in the process. I think people get a sense of what is happening, right? But also equally there is this danger of very aggressive communication to mislead the unsuspecting investor that everything is hunky-dory. And some of our so-called good practitioners of governance are guilty of this. How do you manage perception to impact on the way people look at your company when the reality might not be matching the perception? We have issues. Some more questions.
It's not a question, just a comment, Mr.
Disclosure, disclosure. You are from the press. You are from the press. You must say that first.
Yes.
Yeah.
Mahalakshmi from Money Control.
I know.
So just one point, which is that, you know, around this governance, I think just one example I want to talk about, which sort of may change our perspective of how we think about governance, because I've also thought about it a lot. You know, which is the best governed company in the world? As far as markets are concerned, most, you know, lots of people in the world will believe that Berkshire Hathaway by Warren Buffett is one of the best governed companies in the world. But you really think about it, there are so many points you can think which will not conform to the ideal of a well-governed country in the world. You know, he didn't announce succession till he was 93, right? Only last year the succession was announced. He still runs the company with no, you know, with just 4 people at 95. He has been holding such huge amounts of cash, which no other insurance company will be allowed to do. All the board members that he has, Warren Buffett, Ron Olson, so many people, no rotation of members, independence, all the conversation that comes into governance frameworks. None of it, and yet they are, you know, the image of Berkshire Hathaway and Warren Buffett is one of the greatest, you know, icons in business, right? So what is it really? Over the years, I think the trust that a company builds or a leader builds, that is what really stands out. So you could break all governance norms. By the way, even in business, they were the last one to really invest in renewable energy. They were way behind in investing in renewable energy, and Berkshire Energy also. So somehow I think it's the trust that a company creates or leaders create over many, many years, which you rightly pointed to, Mr. Damodaran, like with culture of the company, how you inculcate all that. That's what really stands out. So somewhere I think if the focus sort of shifts around building the culture and trust of company leaders within employees and the ecosystem, it will resonate better and probably solve a lot of these trade-off that we talk about, because then markets also become more tolerant or forgiving of, if you had some missteps, they know that the heart is in the right place, you do the right things, and you will carry forward in the right way.
You weren't here yesterday. I made a statement that in the beginning God was in charge. Then the state took charge and failed. Then the markets took charge and failed. And now God is saying, give it back to me. I will manage the system. Yeah, Mukesh.
Mukesh Bhutani. I see an inherent conflict between growth and governance. I'm glad, Mr. Damodaran, you mentioned about 2,500 companies out of the 5,000 should not be listed. Assuming top 200 balance governance and growth, I just wanted panel's view. Do you really think that we have reached a level of maturity where majority of our listed companies do actually balance it very well?
Good question. I don't want to do an audience poll because all of you, I believe, are those that subscribe to the concept of good governance and the importance of governance. In another larger audience, maybe I've done an audience poll and got many people to support what Mukesh is saying, but take your question. Yeah.
So I didn't quite hear you. What were you saying?
I'll answer that. So no, he was saying that there are about 2,500 companies in India which are probably, like Mr. Damodaran's comment, he said was, I think he said in a half casually when he said they shouldn't have been listed, but I don't think he exactly meant it. Okay, just to start that.
No, it is true that many of them, you see, when long before LODR came and clause 49 was the ruling god at that time, those that were not complying with clause 49, exchanges were very upset with them. I asked the exchange one question: are they complying with all the other clauses? 49 is okay. Are all these companies, these 2,000 odd, which are dying to delist and get out and don't know how to get out? They say, about marriage, that it's like a besieged fortress. The guys that are outside are trying to come in and the guys that are inside are trying to go out. Right? So it's much the same thing. That there you have companies which got listed because favorable tax regime, whatever, and then they can't comply. They want to delist, but it's not easy to delist. So it's a load on the regulatory system. You have to keep track of guys who don't belong in that universe. And it's close to 2,000
I was hoping you were meant in a lighter way and looks like I'm serious about it.
To Mukesh's question, do you have any answers? That is the direct question.
I think about these things, in this context. See, end of the day, we are saying that we are like a $4 trillion economy. We want to be a $30 trillion economy in so many, maybe 20 years, 25 years. We want to say that, the Indians should be able to participate in listed equities a lot more. It's not about savings. And we see the world moves there. We know businesses create value. So when all this is true, then we must find a way of, enabling them, bringing them up, educating them about conflicts of interest. You'll be surprised, many corporations or maybe small companies, family-owned companies, they run these, 2-3 family members come together and make a member of board and they put it together. They don't even understand conflicts of interest. So it is not there because they're not grown professionally. For example, one of the things that we follow in our bank, and I tell people, saying that if you're a subordinate and supervisor both go for lunch or dinner together, he says, it shouldn't happen that the subordinate bills and the supervisor pays it off. Right? This doesn't look governance, right? So he said, let the supervisor pay and that person supervisor sign it off, right? So it's a small thing like governance, but people are not aware of many of these things because maybe they're just, maybe they're just good business people, but they were not born to this ecosystem of coming up in the professional environment of what is good conflict of interest, what is not, and so on. So the point, therefore, is that my view is that we should find a way of bringing up the curve for the future of India and Indian corporate sector, rather than saying that they don't belong there. Because we need a large listed equity market in the country.
Exactly.
I mean, if you look ahead, we really can't be taking only the best educated professional people running companies and बाकी सब साइड पे बैठ जाओ तुम समझते नहीं हो. ऐसा देश कैसे बनेगा फिर?
My question was not on the delisting part of it. My question was, given where we stand.
It doesn't look like. We agree that it's not that mature. I don't think we can debate on that at all. I do believe there's a lack of maturity. Otherwise, why would there be so many scams? So why would there be so many thin listed companies, flying off the shelf, in some various prices and so on and so forth? Of course, we're not there. But I'm saying we need to go there. And we need to put real efforts, and of course, regulator and ecosystem, and everybody has to make an effort.
Sure, absolutely.
Yeah?
Absolutely.
Yeah. Yes.
Sir, I have an observation. This will be obviously everybody's frustration, but I'm just voicing it, that people who want to do good governance, are they allowed to do good governance? Because recently, few months back, real estate industry put together a whole representation giving out the breakup of the costs they incur for projects. And some of the costs were completely out of ordinary, or they've become ordinary over time. I'll give you an example. There are so many private equity funds of vintage 2007, and over time they are obviously out of life and they should close. SEBI is pressurizing them, you have to close. Income tax has kept cases open for them and they are not closing them. So they are saying we can't close. Now between income tax and SEBI, they are just answering them, we can't do this because of so-and-so. We can't do this because of so-and-so. That is good governance. Funds want to close, and by far we haven't seen bad governance in funds so far. So I'm saying they want to do good, but they are not allowed to do good, and they are spending money rather keeping those funds open. Because they are not charging fees, they are communicating with investors, they are doing everything. They've sold all assets. But they've kept some funds pending because of the income tax demands, which are not getting settled.
The intentions are good, but they're unable to translate them into action because there are authorities getting in the way.
Exactly.
Regulations or whoever.
Yeah.
That's basically what you're saying.
Yeah. Exactly. And this is probably the case with a lot of companies.
Nothing that we can do to address that. That's a very complex question.
Sir, the larger issue will be when such things happen and seniors have to do things to keep things going, it will look like bad governance. And it can even percolate down to people thinking, this is passe, we can do this. It gives an impression about the company to be bad. And therefore, when we talk about giving perfection from listed companies and all, we want them to be perfect, give them perfect environment. That's the larger issue, I think, which everybody has a problem with.
I'll give you an institutional answer to this, which is that yesterday we launched the directors community. You join that, strengthen that, and get that community to ask the right questions.
Yeah.
Maybe that is the way to go. We'll take one last question. Yes. Bolun.
My name is Sushoban Sarkar. Generally, there is a consensus that governance is good in the long term. And we know that in the long term, we are all dead. My point is, in the short term, growth is an existential thing. So, when we come into an existential situation, governance will not be sacrificed. I mean, governance is more likely to be sacrificed. So what is the opinion of the panel on this?
You talk to the average startup guy and tell him you should have good governance practices, policies, etc. Say, we'll do it after 5 years. We have to grow now. Otherwise, our investors will ask the tough questions. So governance will be running far behind growth. I'll tell you something in a lighter vein. In the Tokyo Olympics, we had a very good sprinter in the Indian contingent. Something was stolen from the Indian contingent's camp. And they saw the fellow stealing it and running, and the manager told this sprinter, you go and catch him. So he ran after that chap, both of them disappeared from sight, and after some time, the legendary sprinter appeared all alone, and he was asked, did you catch him? He said, catch him? I overtook him. Right. So that's the only known case where the policeman ran ahead of the thief. Otherwise, you will always have people who are running behind. Governance is playing a catch-up game, but it shouldn't be too far back. If you expect it to run parallelly, that is more hope than expectation.
Also, governance is not just something at the top. When you're growing, you have to ensure that all your systems are in place for that growth.
Practices,
your
controls.
policies, practices, processes, etc. And it is actually enabling that growth. So this is a very systemic approach to growth.
Yes.
So I think you can't get away from it, even in the short term. And if you don't do it, you will suffer. So in a sense, good governance is essential, in my view, for short-term growth.
But Nasir...
That's why we call ourselves enablers.
Yeah.
Okay.
No, but to be fair to his question, the reality of life is that we often face serious dilemmas, okay, which, frankly, after organization evolves, like fully we evolved right now, an organization, right, I know my whole existence, you know, governance is, it's relatively easier to practice, but I mean, it's always important to practice, no question about it, but relatively. I can tell you my experience on this issue. The previous company which I first acquired, much before, like 2010, 12 or so, there was the company had a net worth of some 680 crores. It had a subsidiary company which was making big loss, but was not accounted for. After I took over, the auditor immediately came to me and said, Mr. Vaidyanathan, you please write this off, because there are no books in the account, right? Now, it's a non-bank fund company starting up. You write it off, you're lost, no bank is going to finance you, because you're a loss-making NBFC, you finish, you don't get funding, and you die. And it was a really bad shape. Now, if you disclose it fully, then you say, fine, your net worth is eroded. You know, if you don't disclose it, then you're fudging. Then you're no different than a Satyam, right? Or something like that. So these are like horrible dilemmas to be in. Okay? And this is not one. I mean, I dealt with it. I finally came out of it in a clean way. But I had my own ways of getting around it. I went and, talked to certain investors. I tell there's a real problem. It's a good problem going to come at me very, very quickly. I bought some time with those people. And I somehow got myself out of the hole. But things are like this. I often in the corporate life, particularly early stage, you are at the horns of dilemma and you're either way finished. And then it becomes, that's when, when we're in crisis, is when governance is truly tested, not in the good times.
Okay, we'll take one last question and then close. Yes, I see a hand going up at the back. Yes.
So listening to the last question, my name is Hemant Pandya from JM Financial. While listening to the last response from the panelist, something struck me. Wanted to ask the panelist your views. What is harder in practice? Achieving discipline in growth, or having what do we say? Discipline when there is higher growth. So what is harder in practice, sir?
Sorry, what is it? Discipline or growth?
Yes. The mother question that you posed. Yeah. That's the mother question.
Yeah. Right. No, sorry, your question is, do you have discipline or you have growth, is it?
My question is achieving discipline, achieving growth with discipline, or having having discipline when there is higher growth. What is harder in practice?
I'm not understanding the question.
I didn't get the drift.
Yeah, really. I didn't get the question. Are you saying that there's no dilemma between discipline and growth?
Yes.
In fact, one supports the other. If you have a disciplined approach and you have a very well-defined approach, your growth is going to come because you are doing it in a very systematic way.
So think of it like this. If you don't have brakes, you can't drive your car fast enough. You won't drive it, right?
Yeah.
Because you'll So brakes are as important, disciplines are as important. Otherwise, you just can't grow.
Yeah.
Okay, let's break it.
That's it. So each one can decide what he or she thinks. That's all that I can suggest. If you think growth should run far ahead of governance, good luck to you. If you think governance should run alongside growth, then see whether the growth is enough to sustain the company. Good. Thank you very much. Thank you to my panelists here.
So thank you, Mr. Munji, Mr. Vaidyanathan, and Mr. Damodaran for a thought-provoking and final session for this year's summit. May I now request Mr. Damodaran to please present a memento to each panelist. On behalf of each panelist, Excellence Enablers is proud to have sponsored Education for One Girl Child for 1 full year through the NGO Nanhi Kali, a Mahindra initiative. Thank you, Mr. Damodaran, for doing the honors. Let's once again give them a big hand, ladies and gentlemen. So thank you, ladies and gentlemen, for being with us since yesterday. We are now at the concluding part of Gatekeepers of Governance, and it's been a very informative, energizing, and enjoyable 2 days of deliberations and conversations. Thank you to all our panelists and moderators. And now to bring the curtains down on this year's summit, may I call upon Mr. Damodaran.
The last session is over. All that I have to say is to thank you. There was a person who went for dinner, and after he had a good dinner, he was told, now you have to say something about the dinner. And he asked the hostess, do you want a long speech or a short speech? The people who heard him said, no, with short speech is better. He said, let me tell you both my speeches. The first one is, the short speech is thank you. The longer speech is thank you very much. So, thank you very much, all of you who've been here. Not that I intend to make a long speech. You've been a great audience. I think you will agree we've had some good sessions, some good speakers. We've had, for the first time, regulators speaking the kind of language that you and I wanted to hear as people in the market, saying positive things, communicating the intent to balance between their job and what the market requires in terms of simpler, faster growth and better processes. We will build on that. We have taken note of the various points that they have made. And what we have been doing, and this we've been doing quietly without sharing it with too many people, is we've been sending communications to the government and the regulators where we feel strongly about something. We write to them saying, maybe you want to look at this. Luckily, yesterday, many of the things that we have been writing over the years found expression in Mr. Amitabh Kant's speech. And when Amitabh Kant speaks, people take notice, because I always tell him he's a very dear friend. I always tell him everything can be divided into 2 categories, what Amitabh can and what Amitabh can't. Right? So, but now that he has spoken, I think we will see the right momentum, the right drift. All that's left for me is to thank a few people who put this together. I mentioned Divyani Garg yesterday. Let me say just this and stop, that if she wasn't around, this summit wouldn't have taken place. But assisting her are a bunch of very hardworking, committed, enlightened young ladies who make life difficult for me. They insist that I must attend office regularly and stuff like that. And I have to go there. I thought that I set it up. I set up the office, but now they call the shots. So let me acknowledge a few people here. Prerna Mohan, is she in the audience or outside doing some work? There she is, bringing up the rear, as they say. Thank you, Prerna, for all that you've done. Swati Dobrial, who is not here, but who's put together our entire media campaigns, etc., all the colorful work that you have seen is done by her. She's not here today, she couldn't come. Nidhi Kapoor, who has been looking after all of us here. Is Nidhi here? Yes, there she is. Thank you, Nidhi. Muskan Saxena here, managing the stage manager. And of course, my list will be incomplete if I don't acknowledge another person who is the major shareholder of the company, significantly large shareholder, but does not behave like large shareholders, does not insist that her voice is the one that must be heard and respected, allows us the freedom to run the company. My wife Tulsi, here in the audience, I hope. Yes. She's there, she's on a wheelchair, so I can't ask her to get up because there could be domestic conflicts if I do. But let me acknowledge that, as they say, behind every successful man is a woman. This woman has been alongside me for 52 years plus, putting up with a lot of things. And let me thank her for her contribution. Thank you very much. I think lunch awaits us. Right. So lunch, the same venue as yesterday. Thank you very much.
Once again, ladies and gentlemen, thank you for gracing this event with your presence, and please do join us at Cullinan Restaurant right on the second floor. Thank you.